The committee will come to order. Let me particularly welcome our witnesses this morning, very distinguished group of witnesses, and let me welcome all others in attendance. Today is a very important hearing that will deal with the question of capital requirements and accounting rules that determine what counts as capital in our banking system. And clearly, I think it should be obvious to all that capital, in the end, is the key to safety and soundness in the banking system. It really undergirds the system, and it provides in many ways the discipline to keep the system working safely and soundly. There are three lines of defense in keeping industry losses to a minimum, and in the worst case, avoiding any eventual taxpayer bailout through federal deposit insurance. The first, of course, is the prudent use of depositors' funds by means of the underwriting practices carried out by loan and investment officers at banks and thrifts. The second level of defense, if you will, in a sense, is the private equity capital that the shareholders have invested in the banks and thrifts, both initial capital put in and retained earnings over the years, and that provides a second line of strength with respect to protection and capital. The third and the last, of course, and the one we hope seldom if ever to have to get to, is the federal deposit insurance, which is there as a matter of our national interest in having a safe and sound and stable banking structure. And in worst case situations, and we have seen clearly some of those now, then there's a requirement to use that as our last resort in terms of a source of capital. During the 1980s, I think it's fair to say that each of these areas was weakened. Starting with the first, many lending officers were convinced by inflationary trends that real estate values could only go up, and it appears as if there was a considerable loss of sight of fundamental economics that were beginning to build up, as evidenced by vacancy rates and cash flow. Some banks and thrifts allowed their capital levels to erode. The deposit insurance fund for thrifts became insolvent, and the deposit insurance fund for banks has also reached a historic low point. In fact, the FDIC has just, as we know, recently taken up a recommendation to increase the deposit insurance premiums paid by banks to try to stop the erosion in the balance in the bank fund and to build it up. We will be reviewing here in this room tomorrow the condition of the banking system, and again on Wednesday when the General Accounting Office and the Congressional Budget Office will also be here to be heard from. Correcting the problems of the past is hard work, and no one knows that better than you individuals at the table, because you carry so much of the burden now for dealing with the problems that we're aware of. And as more conservative lending practices are applied, some borrowers are bound to protest as they are doing, and we've talked about that to Comptroller Clark directly. As deposit insurance premiums are increased, some shareholders of banks and thrifts will complain about devaluing the charter and even raise the question of whether they can afford the premiums, and I'm sure, Bill Seidman, you're probably hearing some of that commentary already. The debate over these issues is complex and arcane, but the capital question really becomes quite simple in the sense of having to determine how much is enough. We faced that question for savings and loans last year, and it was one of the most contentious issues. Today we face a similar question for banks. The issue is what will be the required leverage ratio for banks. Now, the Comptroller has proposed lowering the leverage ratio to 3%. The Federal Reserve has proposed a leverage ratio of 3% plus an additional amount for all but the highest rated banks. The FDIC has not yet issued a revised leverage ratio. This debate on the bank leverage ratio has been going on since October 25th of 1989, when all the bank regulators testified on the condition of the banking industry, and I think it's time to make an all-out effort to try to resolve it. The importance of the leverage ratio cannot really be overstated. Even though we are embarking on the new risk-based standard that may ultimately prove beneficial, I am concerned that too much reliance on an untested standard could have a profound set of unintended effects on the safety of the banking system and on our economy as a whole. And I think we're at a point where all serious discussion in this area has to have that very much not just in the background but more in the foreground. What is the strength of the system now, and how do we make adjustments without applying greater stresses and strains than prudence would dictate? Today we will also review the accounting standards that determine the rules for what counts as capital. And I was heartened to hear Director Ryan state that accounting rules should reflect economic reality. I look forward to hearing his views as well as those of the other regulators here today. Section 1215 of the Financial Institutions Reform, Recovery and Enforcement Act of '89 requires that the bank and thrift regulators report to Congress on capital and accounting standards. I've also asked SEC Chairman Breeden for his views on the accounting standards, and we look forward to his appearing on a second panel here this morning. So I want to welcome all of our witnesses today and to say that we're very glad to have them back before the committee. And I will proceed this morning in the following order. I will call first on Robert Clark, and then on William Seidman, and then on Timothy Ryan, and then finally on Wayne Angel. So we'll go in that order, and Controller Clark, we're pleased to have you, and we'd like to have you start out.
Thank you, Mr. Chairman. I, as you have stated, am here with my colleagues to report on the progress of the federal financial institutions supervisors toward ensuring that banks and thrift institutions have adequate capital to support their operations. And I'm also here to discuss our actions on capital adequacy, which I believe, and you have certainly underscored, are so critical to our efforts to assure a safe and sound banking system. As you know, I've submitted a written statement that discusses both of these subjects in detail, and if that statement is incorporated in the record, which I would ask that it be, then I'd like to focus my time on a couple of other important points in my opening statement.
Very good. We will make your full statement a part of the record, as we will for your colleagues who are here. So I would like you very much to summarize and focus your comments where you think it's most important for us to hear from you.
Good. As you know, I testified before this committee almost a year ago on the subject of capital. And at that time, all three federal bank regulators, along with the banking authorities in 11 other countries, had adopted risk-based capital guidelines for commercial banks. These rules were based on the principle that a bank's capital requirement should reflect the riskiness of its assets. The guidelines also importantly redefined capital to require that at least 1/2 of a bank's regulatory capital consist of core capital, that is to say primarily common stockholders' equity and related surpluses. In short, our adoption of those rules after years of international negotiation and debate was a significant move toward a tougher standard of capital adequacy. Moreover, Mr. Chairman, Congress recognized the advantages of our risk-based capital approach in enacting FIRREA last December. That law called on the Office of Thrift Supervision to establish risk-based capital standards for savings and loan associations, which are based upon the same principle underlying the standards of the banking agencies, even though they are different in some technical respects from the guidelines for banks. Thus, all of the federal agencies today have generally similar minimum capital requirements and accounting rules. Some differences do remain. But except for the differences between bank and thrift capital standards that are mandated by FIRREA, most of the differences are minor. Adequate capital forces market discipline on a bank, putting pressure on bank management to operate efficiently and decreasing the willingness and the ability of the bank to gamble with insured deposits. It also protects the institution from insolvency due to unanticipated losses. And in doing so, it preserves the franchise value of the institution and prevents claims against the Deposit Insurance Fund. We cannot, however, always assume that the more an institution is capitalized, the better its financial condition. At some level, the costs of holding capital begin to outweigh its benefits. And when you reach that point, if you have capital requirements that are too high, there is an incentive for some institutions to increase risk-taking to cover those costs, with the result that there can be more rather than less risk to the insurance fund. Other institutions may find it impossible to compete effectively if the costs of capital are too high. So supervisors have to strike a balance in setting capital standards that will provide market discipline and protection from insolvency, while at the same time being attentive to the importance of the competitiveness of banks and the ability of banks to provide an acceptable return to the providers of capital. I believe that our risk-based standards strike that balance. By the end of this year, banks will be expected to have total capital equal to 7.25% of risk-weighted assets. When the standards are fully phased in at year-end 1992, banks will be required to have total capital equal to at least 8% of risk-adjusted assets. 8%, I emphasize, is a minimum, just as the capital standards that we are phasing out are minimums. Most banks will be expected to maintain even higher capital levels, and historically, most banks have operated at capital ratios far higher than the minimums that we have set in the past. Even so, the risk-based capital guidelines alone will increase significantly the total amount of capital required in the banking system, and importantly, they require the greatest increase at multinational and large regional institutions. These are the institutions that, because of their size, present the greatest risk to the insurance fund, and they are the institutions that have in the past produced some of the biggest losses. But of at least equal importance is the fact that these guidelines increase the quality of capital as well as the quantity. Old standards allowed the loan loss reserve to be counted in primary capital. The new standards insist that at least 1/2 of the capital required by the risk-based formula be pure equity capital, and of the other half, only a fraction can be represented by the loan loss reserve. My written statement discusses these issues in much more detail. Mr. Chairman, risk-based capital standards are aimed at asset risk, the risk that the value of an asset will decline. But banks are also exposed to other types of risk, interest rate risk or foreign exchange rate risk, just to name a couple. And not surprisingly, the principal protection against these other risks is also capital. So last year, all 3 federal bank regulators agreed, as you noted, that in addition to the risk-based capital guidelines, there had to be an additional backstop to the minimum level of capital that a bank must hold. And that backstop we call the tandem leverage ratio. Without it, the guidelines could theoretically allow a bank to operate with no capital, for example, by investing all of its deposits in U.S. government securities which have a 0 risk weighting. Now that, of course, is an extreme example, and I would suggest that the likelihood of something like that happening is slight, but the concept, I think, is there. We did believe that a backstop to the risk-based capital guidelines was necessary, and we believed that that backstop should consist only of common equity capital and surplus, real capital, so to speak, capital in its most tangible form. The tandem leverage ratio is a supplement to the risk-based guidelines because a bank would have to meet, at a minimum, both. A bank that satisfies one minimum requirement but not the other would have to raise capital or adjust its portfolio so that it meets both. Therefore, the tandem leverage ratio cannot be viewed in isolation. Its purpose and effectiveness must be evaluated in the context of the overall system of capital regulation. Now, I want to note here for the record that the minimum leverage ratio strikes a balance between the cost and benefits of capital requirements, a balance that is inherent in all capital regulation. We believe the OCC's proposal of a 3% minimum leverage ratio for top quality banks strikes that balance. It allows the risk-based standards to work while at the same time protecting the safety and soundness of the national banking system. Higher or lower minimums for the tandem ratio would result in one or the other of those goals being compromised. Specifically, a higher tandem ratio would undermine the risk-adjusted capital guidelines, and in doing so, it would undermine all of the work which we have devoted to achieving international capital standards that match a bank's capital requirements to the riskiness of its business. Mr. Chairman, in closing, I would like to put capital adequacy regulation into the context of bank supervision generally. The recent crisis in the thrift industry has made even clearer the fact that to ensure a stronger and sounder banking industry, we must have appropriate accounting standards, real capital, and strong supervision. Capital adequacy is a critical element in this mix, but it cannot stand alone. Capital standards are effective only if they are accompanied by the 2 other elements. We've taken significant action over the last years to assure that all those elements are present. In regard to supervision, for example, the OCC has implemented a new closure rule that allows us to close an institution when its equity capital is eliminated. In the past, our policy was to close an institution when its primary capital was exhausted, and as you will recall, primary capital included the loan loss reserve.
Right.
Our new rule allows us to close an institution when its equity is exhausted, but while reserves still exist to cover anticipated and identifiable losses, which thus limit the opportunities for excessive risk-taking by bank management. And we expect decreasing the cost of most bank failures, in some cases significantly. Mr. Chairman, this is one of several examples of the progress that I believe we have made over the last year in assuring a safe and sound banking system in the years to come. I appreciate having the opportunity to talk to you about this progress and would be pleased to answer any questions that you or any other members of the committee may have. Thank you.
Thank you very much, Comptroller Clark. It's a very helpful summary. Next, we'll hear from William Seidman, of course, who serves as the chairman of the FDIC.
Thank you, Mr. Chairman. I applaud your holding hearings on this subject, and particularly on the differences between the agencies with respect to capital requirements. I think we have gone far too long with those differences outstanding, and I think those differences are a problem for the industry and its planning, and I think we have to come to a resolution of differences between the various regulators, and I believe that this hearing will be a very useful step in achieving that result. And I would like to note that while we have significant differences, we in fact agree on many more things than we disagree, and your amiable regulators have actually met most of the test of coming up with common standards. However, there are standards which we have not been able to agree on, and I do not think that we can continue with those differences without causing real harm to the system. So I would like to concentrate and talk about the same subject that Comptroller Clark has talked about. As you know, I have covered a number of other items in my written testimony. The banking agency's existing uniform leverage requirements are based on a definition of primary capital plus secondary capital. And as you've heard, the agencies are revising these standards so that capital definitions will more closely track those used in the risk-based capital framework. But as one who participated in the risk-based process at the international level, those standards were primarily designed for banking systems around the world where almost all banks are large banks and international banks. The standards, I think, are useful and they can be used for smaller banks, but no one else in the world has a banking system like the United States with thousands of small banks. And I think it is a real error to try to force conformity of the American system in total with the risk-based standards. They are, as anyone who looks at them can see, very rough standards. I mean, there are weights there that have been sort of compromised and agreed upon. I think they're good standards, but they are certainly rough estimates of risk in an institution. So we believe that the agencies in adopting new capital standard should avoid any meaningful reduction in minimum capital standards for any large number of banks. I have testified before this committee before that the standard of 3% as a minimum standard would reduce the minimum standard for a substantial majority of all the banks in the country, and primarily the small banks. We think that's unwise, and that's why we have not been willing to agree that a 3% tandem standard is the appropriate standard. In this regard, the Federal Reserve has now put out their standard, and I think really in the spirit of compromise to use the 3% number in order hopefully to get to some kind of agreement with the controller, adopted the 3%, but said that that only applied to the highest level of bank ratings, Camel 1 banks. The fact of the matter is that there are practically no Camel One banks with 3% capital because they all have more than that. We agree, however, with the Federal Reserve's definition, which in substance means that practically every bank in the country would have to have 4 or 5% based on the assets of and risk of assets in the institutions. This is a somewhat awkward way to move towards a compromise, I must say. We would have preferred to go to a standard which would not have reduced minimum requirements for the great majority of banks, which we find to be somewhere around 4.5% rather than the 3% number. However, we have no problem with the Federal Reserve proposal as it has been adopted. Our staff has come up with a comparable recommendation which it will be putting to our board. But since our board has two of the gentlemen who are with us today, you can see that there may not be total unanimous agreement with the staff recommendation. I think above all it is important that we get uniform standards, and as I say, insofar as the FDIC is concerned, we would prefer to have a 4.5% tandem standard, but we find the Federal Reserve proposal satisfactory, arrives at substantially the same result, and so our staff is going to propose to our board that we adopt the same standard as the Federal Reserve has adopted. Now, this disagreement may sound like regulators splitting hairs. I mean, 3% and 4.5%, well, there's only 1.5% difference. But it is a very material difference when one looks at the banking system and sees that at 3% there are substantially all banks, all smaller banks, would have a lower minimum standard. So we believe a prudent minimum leverage requirement must be maintained as a check on institutions with only limited credit risk, but with significant exposure to other risk, and particularly including interest rate risk. In that regard, the international group is coming up with an interest rate risk test. It's a very complicated test, but it would move to meet some of the problems that we have been discussing. But at this point, of course, it's not in place, and I don't think it will be for some time, and that makes urgent that we reach an agreement on the core capital leverage ratio. If we were to go to 3%, then guidance must be given, as the Federal Reserve has given, on how the 3% applies, and we do not find that in the present situation. As you know, if you look at banks today, most banks have loan loss reserves in the area of 1 to 2%, and since the required amount is 5.5 to 6%, that almost automatically gives you the number that something around 4% is where bank capital is today on an overall average basis. I would hope, and I have hoped all during this discussion that has been going on since last October, that reasonable men could agree on a standard here. I consider my good friend and doubles partner in tennis, Mr. Clark, to be a reasonable man in almost all respects. But we have not been able to arrive at a conclusion in this, and I hate to implore help from the outside, but at this point, all I can do is say that we have done our best to try to reach an agreement and have not been able to do so.
Well, I appreciate what you've said, and before we move on, I think it's fair to say that the country wants and very much needs strong and competent independent regulators, and there are going to be issues that arise where there will be professional differences of opinion, and I think that's to be expected. But at the same time, I think after some reasonable length of time and the exchange back and forth, issues do have to be settled, because there's enough stress out there on the banking system and in our economic system to we don't need any more that comes from uncertainty that it can otherwise be taken away by resolving these issues. I'm going to have some questions along that line, but I just it might be just appropriate before we go next to Mr. Ryan to ask Mr. Clark, having just heard what sounds like an offer to, on behalf of Mr. Seidman, to go with the Fed position, would that be something you would feel you could do too, or?
Well, Mr. Chairman, if I may, I would like to have a chance to respond to that, because unfortunately I think we're talking about something that doesn't really justify the amount of time and effort that is being expended debating it. And in fairness to Chairman Seidman, we have not yet published our final risk-based guideline, which contains our final version of the tandem leverage ratio. But I think when it is published, all will see that the differences between what the Fed has published as their final rule and what we will publish as our final rule are extremely minimal. And if I may, I'd like to quote to you from our final rule, which says that the leverage ratio, the 3% leverage ratio, is acceptable only for a bank that has excellent control systems, high asset quality, and well-managed on-balance sheet and off-balance sheet activities. The Fed statement, as you know from having read it, establishes virtually the same types of criteria for the banks that would be allowed to operate at the minimum leverage ratio. And as Chairman Seidman has indicated, there aren't very many of those that meet all of those criteria. And so we would expect that banks would operate at that most banks, as they do today, would operate at higher levels than the minimums, whether they be the risk-based minimum or the leverage ratio minimum. Now, I would also go on to say that, as you know so well, as all of us at this table know so well, bank supervision is a judgment business. And under our old 5.5%, 6% guidelines, which we're phasing out at the end of this year, those were minimums. Most banks operated above those minimums, and the levels that we required them to operate at above those minimums were decided upon on a case-by-case basis. And I would expect that we would do exactly the same thing under these new risk-based and tandem leverage ratio standards. And so all we have done is set out a minimum leverage ratio, a minimum risk-based standard, and say that only the very best banks are going to be allowed to operate at either of those minimums, and that we will use our judgment as we have in the past to set what standards, and as all the other agencies have done in the past, to set the higher levels. And finally, I would just underscore the point that I made in my oral statement, and that is that we have all embraced the risk-based capital standards. Not only is it part of an international agreement, but it's an agreement domestically among all the federal bank regulators. Congress, as I indicated, embraced the concept of risk-based capital in FIREA for thrift institutions. I think it is very important that we allow the risk-based capital standards to work, because I think they are a material improvement. And if you look at the number of banks that don't meet the risk-based standards today, and certainly the number that didn't meet the standards at the time we embraced them, compared to the number of banks that don't meet our old standards, you see that the risk-based standards have resulted in a substantial amount of additional capital being required in the banking system. We need to give those guidelines a chance to work. At the same time, we need to backstop those guidelines with a leverage ratio which in most cases will be substantially higher than the minimums that we've set out. I hope we can get this resolved.
Mr. Seidman?
Well, Mr. Chairman, I would only say that if the 3% doesn't apply to anybody, it seems to me that it's not reasonable to say that it arrives at perfect balance between the leverage ratio and the risk-based ratio. I mean, it's almost becoming something of Alice in Wonderland. How can we need 3% in there when we all agree that the highest rated banks all have? In fact, we searched, we couldn't find anybody, but we may have missed one or two. And the other point I would make, that our study shows that without a number higher than 3%, approximately 10,000 banks' minimum capital standards will be reduced. And that's what we oppose. We, of course, are the primary federal regulator for small banks, and those are essentially what we're talking about. And it seems to me that we ought to be able to get over this one, and all we're saying is we don't want 10,000 banks to believe that their minimum capital standards have been reduced.
May I just ask one other thing before going to Mr. Ryan, to you, Mr. Seidman, and that is, You know, we've been pretty badly burned by the call on citizens to back up the deposit insurance fund on the savings and loan side, and we're down to a pretty modest balance in the banking insurance fund. I'd like you to be as direct as you can be about the degree to which any concern you have is on this issue relates to just the basic soundness and strength of the insurance system. I mean, do you see a risk there? Does this issue relate to potential risk in terms of the insurance system itself as you would see it?
I think it does relate directly to the safety and soundness of the insurance system, because it relates to how much capital banks will be required as a minimum to carry. And that is at least our first line of defense, as you pointed out, or our last line of defense, however you want to put it. But capital and the amount of capital is clearly an important factor. Chairman Greenspan gave a speech the other day in which he, in effect, said capital is the main defense and we need to increase it. I can't find a way to, no matter how much I wish to compromise, to agree on a standard that will reduce the minimum standard for 10,000 banks in this country under current circumstances. The insurance fund is under substantial pressure, the worst it's had since it's been in business. We're not over the hump yet. We've predicted the possibility of $2 billion of loss in the fund this year. It may be lower, but it could be higher. So I think it is clear that we ought to be doing everything that we can to ensure protection for the fund, and the primary protection beyond the way banks operate is the capital.
Well, gentlemen, I want to come back and pursue this, but I think we ought to hear our other two witnesses and get them on the board here. You both have had a chance to comment twice, and so maybe we'll go now to Director Ryan and then to Board Governor Angel, and then come back and we can pursue this further. But Director Ryan, pleased to have you.
Good morning, Mr. Chairman and Senator Bond.
Oh, excuse me, I'm sorry. Senator Bond's come in. Senator Bond, would you like to make an initial comment at this time?
Thank you, Mr. Chairman. I have a couple of questions I might want to pursue afterwards, but I'd be interested in hearing the other two witnesses before we get into those questions.
Very good. Director Ryan.
Thank you. Capital and accounting standards are of paramount importance in policing the health of the thrift industry, as they are two of the most important tools we use to ensure that the industry operates in a safe and sound manner. Taken together, they determine the amount of private risk capital that is required of banks and thrifts. As the Congress recognized when it passed FIREA, capital is the primary buffer between losses at insured institutions and the federal deposit insurance funds, and ultimately the taxpayers. The losses that the S&L Industries Insurance Fund has suffered over the past several years are primarily attributable to the fact that some associations took risks that were far too great, with far too little of the owner's money at stake. Accounting standards are the yardsticks used to measure capital. The accounting standards must represent the economic substance of transactions and need to incorporate safety and soundness considerations. The reported capital should fairly represent the amount of equity that is at risk in the normal course of safe and sound operations. The absence of strong capital and accounting standards in the thrift industry in the early and mid-1980s created intolerable, risky incentives, deferred recognition of the industry's problems, and delayed their resolution. They amounted to a ticking time bomb. President Bush and Congress recognized their importance and in FIREA appropriately required OTS to strengthen both its minimum capital standards and its accounting standards. I support personally both of these goals, and OTS has adopted standards to fulfill this legislative mandate. Last month, I sent to Congress OTS's report on the differences that remain between the capital and accounting standards that OTS imposes on thrifts and those imposed on banks. As the report suggests, Mr. Chairman, while there remain some differences, many, I might add, due to specific statutory requirements, the standards are remarkably similar. We will continue to work cooperatively with the bank regulators to ensure consistent and appropriate regulatory requirements. By way of background, my written statement sets forth the unfortunate history of weakened thrift capital and accounting standards in place during the early 80s. These policies have now been corrected by FIRREA. FIRREA directed the newly created OTS to match the capital and accounting rules that applied to national banks. As the reports submitted by the OTS and our fellow regulators illustrate, we have moved to adopt such standards. We are also taking actions to further harmonize the standards. Many of the remaining differences between our capital rule and those of the bank regulators are due to statutory requirements. This is true of the two most significant differences in our rules, the treatment of goodwill and the treatment of investments in certain subsidiaries. Both of these areas are addressed specifically in FIRREA, and in both cases the differences will be eliminated over time. The other major area of difference relates to assets sold with recourse. OTS has already taken a tough position on recourse issues since our risk-based capital rule went into effect last December, and the 5 federal depository institution regulators are working through the Federal Financial Institutions Examination Council to finalize a rule appropriate to all agencies. I want to emphasize the OTS capital rules, like those of the other banking agencies, are minimum standards. All institutions are responsible for having adequate capital reserves to protect themselves and the insurance fund from risk. We expect thrifts to achieve capital levels that are higher than the minimum requirement if higher levels are warranted by the composition of their portfolios or by risks other than credit risk. As to the appropriate tangible leverage ratio, as you know, OTS is required to be no less stringent than the OCC. Accordingly, once OCC finalizes its 3% tangible leverage ratio, OTS must be no less stringent once FIRREA is fully phased in. As you've seen, the debate continues, though, between my fellow members here of the FDIC, and as you know, I'm now closing my first 6 months, and I'm listening intently to the debate and, quite frankly, to what should really be the appropriate minimum tangible leverage ratio. And as the Chairman has said, that debate will continue very soon within the FDIC, and I look forward to listening to my colleagues and making up my own mind on that issue. But I will stress I do have an open mind on that question today. My report to the committee also highlighted the remaining differences in accounting standards between OTS and the banking agencies. These differences occur both in policies and in practices. Where the insurer and the primary regulator are both examining the same institutions, they are a natural outgrowth of the tension built into the regulatory structure. As in the capital area, we have launched an effort with our fellow regulators to continue to work to narrow down, if not eliminate completely, the remaining differences in accounting standards. We also intend to propose a rule soon that will take advantage of the flexibility given to us in FIRREA to adopt supervisory accounting and reporting standards that are more stringent than GAAP in those areas where we believe that such action is necessary to adequately protect the insurance funds. There are several important areas of accounting where we believe that the range of acceptable practice under GAAP is simply too broad for safety and soundness reporting purposes. A major project that is underway that may help to ensure more useful accounting standards and improve capital adequacy is a review of the feasibility of adopting market value accounting. The Treasury Department, as required by FIRREA, is undertaking a study of reforms to the Federal Deposit Insurance System, including the use of market value accounting. Market value accounting would be useful in ensuring that we have sufficient information to monitor the true economic condition of institutions. While historical cost accounting may have been adequate when prices and interest rates were stable, it is inadequate to cope with the volatile financial marketplace as we now have. Market value accounting should aid in assessments of risk and in the identification of those institutions with economically impaired capital. This is not to say that the adoption of market value accounting is the cure-all for potential problems. There are many questions that need to be answered before it could be adopted, including those of accuracy and reliability of measurement, appropriate methodologies for calculation, and the costs of implementation. An important point to keep in mind, however, is that the benchmark that we should use to compare market value accounting is not perfect information. Rather, it is GAAP information with all of its intrinsic limitations.
What a display of technical wizardry by Senator Bond there.
I think we did it together on a bipartisan basis.
I see, very good. We may send you out to Andrews Air Force Base and see if you can apply some of that.
I'd catch a plane.
The Treasury Department's report will address the issue of market value accounting. At this point, I am uncertain as to whether it is workable. It is, however, if it is, however, it could become one of the most important tools for ensuring accurate information on the financial state of insured institutions. Besides the review of market value accounting, another major project underway is a proposal on interest rate risk. While the existing bank and thrift capital standards are chiefly directed toward credit risk, FIRREA recognizes that other types of risk also need to be addressed. In particular, the statute explicitly permits OTS to add an interest rate risk component to its capital rule. In my view, this is important for OTS to look at this issue. Because thrift industry assets are heavily concentrated in mortgage loans, which are typically long-term assets, interest rate risk will continue to cause substantial risk to the industry. As a result, I believe it is necessary to make our risk-based capital rule explicitly sensitive to interest rate risk. Thank you, Mr. Chairman and Senator Bond, for your patience and for the ability, for the opportunity here to present our views. Thank you again.
Very good, Director Ryan. We appreciate those views. Let us now go to Governor Angel. We're pleased to have you. We don't get to see you with great frequency, but we welcome you, and we'd like to hear from you now.
Mr. Chairman, I'm pleased to be here on behalf of the Federal Reserve Board to discuss regulatory accounting standards and capital requirements for depository institutions. The Federal Reserve has long viewed accounting standards as a necessary step to efficient market discipline and bank supervision. Accounting standards provide the foundation for credible financial statements and other financial reports. Financial statements prepared in accordance with the Generally Accepted Accounting Principles, GAAP, are intended to provide information needed to evaluate an enterprise's financial condition and performance. The regulatory financial statements for federally insured commercial banks and savings banks are the reports of condition and income referred to as call reports, which are currently required to be filed in a manner generally consistent with GAAP. In those few instances where the call report specifies reporting requirements which differ from GAAP, these requirements are intended to be more conservative than GAAP. The Federal Reserve Board and other banking agencies have held preliminary discussions with the OTS to study ways in which a more uniform reporting scheme can be developed for all banking and thrift institutions. The Federal Reserve Board is prepared to work constructively to resolve differences between the call report and the thrift financial report, and urges the Financial Accounting Standards Board and the American Institute of CPAs to eliminate the differences in GAAP as applied to banks and thrifts. More uniform reporting by all institutions is an important goal. A major issue relating to accounting standards is the appropriateness of market value accounting. The problem in our financial system over the last several years have led some to recommend the adoption of market value accounting. It is suggested that the use of this accounting model might lead to a more effective regulation and supervision of financial institutions and to the closure of problem institutions long before they would become insolvent on the basis of financial statements prepared under GAAP. While market value accounting has theoretical appeal, a number of concerns have been expressed regarding this accounting model that should be considered before dramatic moves toward market value accounting are made. The Federal Reserve is concerned that without the development of standards for the estimation of market values, financial statements prepared on a market value accounting basis would not be reliable or verifiable by audits and examinations. The Federal Reserve believes that the studies now underway by the federal banking agencies and the FASB should provide additional information regarding the appropriateness of market value accounting. It is also important to emphasize that much that can be done to reduce the differences between accounting and economic measures of financial condition and performance without adopting market value accounting. For a number of years, the Federal Reserve and the other banking agencies have been working to strengthen bank capital positions. The Federal Reserve has long viewed adequate capital as essential to protecting the soundness of individual banks and our banking system as a whole. I would like to elaborate on some of the important benefits that would result from stronger capital requirements. First, a stronger capital position would strengthen the incentives of bank owners and managers to evaluate more prudently the risk and benefits of portfolio choices because a substantial amount of their money would be at risk. Second, stronger capital levels would create a larger buffer between the mistakes of bank owners and managers and the need to draw on the Deposit Insurance Fund. Third, requiring stronger capital positions would impose on bank managers an additional market test, and that they must convince investors that the expected returns justify the commitment of risk capital. Fourth, strongly capitalized financial institutions are in a better position to take advantage of opportunities that may arise. Furthermore, it would not be necessary to apply as rigorous supervisory attention to such institutions. Thus, it is important that regulators make sure that financial institutions are operating not from a minimum capital base, but from a strong capital base. The risk-based and leverage standards are discussed in more detail in my written testimony in our report to Congress. The primary supervisory emphasis has shifted to risk-based capital. The banking agencies have generally viewed their capital ratios as minimums, and prudent banking organizations would continue to operate with a cushion above the minimum leverage and risk-based capital ratios. Institutions experiencing or anticipating significant growth are expected to maintain above average capital ratios. While capital standards generally provide a cushion against losses from operations of a weak loan portfolio, they do not address all risk of an institution. For example, the bank risk-based capital guidelines do not yet address non-credit factors such as interest rate risk and foreign exchange positions. Interest rate risk has been evaluated in connection with the overall determination of an organization's capital adequacy and financial condition during on-site examinations. Since a conclusive assessment of capital adequacy can be made only after consideration of all the quantitative factors that determine the need for capital, we think it is clear that the time has now come to place greater emphasis on the quantitative measurement of interest rate risk. To this end, the Federal Reserve is working with the other U.S. banking agencies and regulatory authorities of the Basel Supervision Committee to develop methods to measure and address interest rate and other non-credit risk. These methods are necessary to enhance the basic risk-based capital framework. In considering how best to factor interest rate risk into capital adequacy, we are guided by the following principles. 1, the system should provide incentives to reduce risk. 2, the system should assess the impact on the firm of interest rate volatility and hedging activities, including proper risk weighting of hedging instruments. 3, the system should be straightforward so that it can be widely understood. 4, the system or data required should not place excessive burdens on the institution. And 5, the system should strengthen U.S. banking organizations so as to enhance their international competitiveness. While the Board has not officially approved a particular approach to interest rate risk measurement, there are a number of possible approaches the Board is likely to consider. One alternative might be to require all institutions, regardless of size, to provide detailed information on the maturity and repricing of their assets, liabilities, and off-balance sheet exposure. This information would then be used to calculate the institution's interest rate risk exposure and corresponding capital requirement. This approach could impose substantial reporting burdens on institutions with minimal interest rate risk. Another alternative that the supervisory agencies might explore involves a two-phased approach. Under this approach, institutions would be screened by the use of a rather rough measure of interest rate risk derived from minimally enhanced data that is, for the most part, already available in the call report. For institutions that undertake interest rate risk outside of established parameters, more detailed reporting would be required and could be the basis for a more precise calculation of additional capital requirement. In summary, Mr. Chairman, the Federal Reserve believes that both the capital and accounting standards play an important role in the supervisory process. Stronger capital positions and prompt corrective action by supervisors will help reduce excessive risk-taking. The Federal Reserve will continue to work with other supervisory agencies to develop uniform capital and accounting standards that achieve these important objectives.
Thank you very much. I want to move to some questions here, but is there any other, would you want to take this as a time to make any other opening comments, Enderbond?
I'll wait for the question period.
All right.
I have some that would be of interest, I hope.
Very good. Let me say to Chairman Seidman and Controller Clark, I know we have until the end of the year to try to resolve this problem, and we're discussing it and hopefully closing into a common position here even today. I would like to see us get this matter settled. I don't propose that we can settle it here right this minute in the room, But I'd like to see it settled, say, within the next 30 days, if possible, for this reason, that the Congress will be in session through that length of time, and then we'll be adjourning, and we may or may not find ourselves with a post-election session. But I would like to be able to see this matter settled. It's going to have to get settled in any case, and I think we ought to settle it sooner rather than later. And I would like to have the opportunity to have this committee know that it has been settled and on what basis. And so I'd like to encourage that we try to set that as a goal. Is that something you think is reasonable, Mr. Clark?
Mr. Chairman, on its face, it certainly sounds reasonable, but as I indicated before, I'm not sure that I understand what is so unsettled. The Fed has adopted a final regulation that says there is a 3% minimum leverage ratio that operates in conjunction with the minimum risk-based guideline, which is available only for the highest quality institutions, and that other institutions will have to maintain both risk-based amounts and leverage ratio amounts higher than that. We are going forward with a final rule that says that there is a risk-based minimum and a minimum leverage ratio that is 3%, which is available only to the banks that are of the highest quality, and banks that aren't will have to operate at higher levels than that. And as you've heard Chairman Seidman say, the FDIC board is going to consider very shortly a proposal that says that there is a leverage ratio at 3%, as I understand it, which is available only for the highest quality banks, and everybody else will have to meet a higher leverage ratio and a higher risk-based capital standard. It seems to me, as I indicated earlier, that we are really not talking about a matter of any substance here. And we're simply staking out, we've already adopted the risk-based guidelines. For the most part, we've already adopted the concept of a minimum leverage ratio, even though that's not part of the international agreement. We're one of the only countries among the G10 countries that has included a minimum leverage ratio in addition to the risk-based guidelines. But we all agree that that's important, and I don't think we should step away from that. But I believe we are substantially in agreement.
Well, you know, it gets into semantics. We may be substantially in agreement, but if we're not in agreement, and if we don't nail it down and capture it and finish it, then it's still up in the air. And I detect the fact that, well, we may have closed down to what some might see as a small difference. I think we've got to eliminate the difference. I think we've got to get it settled. And the concern that I have, and it relates to something that Director Ryan said, and that is that when we, in the FIREA bill, where we toughened all these standards and we put all of these reforms in place and we keyed that off national banking standards, we didn't think at the time that we might have any divergence with respect to the national banking standards, and we really can't afford to have that. I mean, we've got enough problems over here anyway in the savings and loan system without having any playback of something that isn't completely clear. And so if we're that close, it seems to me then, you know, taking another 30 days to get down to sort of a settlement shouldn't be that difficult. But what's your thought, Ms. Seidman? Is that something that...
Well, I agree with that, Mr. Chairman. Our proposal will be exactly the same as the Fed's. So there will be two of the agencies where there will be no differences if our board adopts the proposal of our staff, which I believe it will, although can't be sure, obviously. So there will be no differences, and the only difference will be whether the controller wants to adopt the same language that is being adopted by the Fed and the FDIC or not. And again, I say that we would have preferred to go to 4.5 as opposed to 3, but in the spirit of compromise and so as not to let the number 3 disappear since there was such strong interest in it, we worked out this other way of handling it with the Fed. And as far as I'm concerned personally, I don't understand really why, if we're so close together, we just don't all adopt the same wording. We have two agencies that have agreed totally on the wording, or at least our agency and I and our staff agree on it. Seems to me we ought to be able to proceed, but that is obviously up to the controller, and since the controller has your law in terms of the national bank standard being a standard that question that seems to me has to be settled one way or another. There's a lot more involved here than just a little tangle.
Well, that's what I want to get to, because I'm hearing Controller Clark saying that this is really a very modest difference and it has sort of an insignificant consequence. And you're saying, I'm hearing you say something quite different. You're saying there is a difference, and in your mind, I don't want to put words in your mouth, you think there is a potentially a very significant consequence as to the difference. Is that?
We are running into that right now because, as I say in my testimony, when you're dealing with thousands of supervisors and thousands of banks, they need a clearly defined standard. If there are differences in wording between these two standards, you can believe that both supervisors and banks want to know why it's there and what the problem is and what is the difference. And we are already running into that in the sense that we are finding many cases where 3% is considered adequate, where because that's the minimum standard. And I think, now I haven't seen Controller Clark's final wording, and it sounds like he's in his wording has moved a long way. I think we have to have exactly the same wording, just the same as we've had in the past.
But just to settle this one issue, at least in my own mind, Controller Clark feels that the differences right now are really quite small and of not great consequence, one way or the other. Your view is that the differences, however small, if left outstanding and not settled, are material and carry some considerable consequences.
In practice, I think they can make a major difference.
If I may say, what is in the rule is not the part that's of consequence, because we're all embracing a 3% minimum leverage ratio and we're all embracing a risk-based minimum guideline. What is of consequence is how we implement those rules. And as I said earlier, under our current guideline, the 5.5% primary capital, 6% test that we're phasing out at the end of the year, all of our agencies have had the discretion to require, and quite often have required, that banks operate above those minimum levels. We've not had formulas, we've not had stipulated percentages that banks have to follow. We've used judgment, we've used supervisory judgment, which I will tell you again, I think is critically important to all of us being able to get our jobs done. If somebody comes back and says, look, after having adopted a regulatory minimum, a minimum leverage ratio of 3%, any one of us are now allowing all the banks that we supervise to operate at 3%, then I would agree with Chairman Seidman that there is a substantive difference. But that's only the starting point, as it has been the starting point under our old guidelines. And I would suggest to you that what is really important, what is really the substantive issue here, is how we're going to operate in supervising banks above those minimums.
Let me just ask you one other thing, then I'm going to yield to Senator Bond, and that is when you said, Controller Clark, that you require capital above the minimum on a case-by-case basis, are you referring to capital directives, and if so, have you been issuing capital directives, any significant number of them, and if not, what steps do you take?
Well, the most frequent step you take is either to get the Board of Directors voluntarily to agree to increase the capital, or to take some enforcement action, such as a cease and desist order or a formal agreement, which mandates that they get their capital up to a specific level and by a specified period of time. The capital directive is another tool that we have, but that is generally one that we implement only if we're not successful in getting it done through the other,
have there been many of those?
Other routes. Not very many, because we usually can get it done the other way.
I see. But I mean, how many? A dozen, half a dozen, two, three?
I can get the number for you.
But I mean, is it a very, I mean, is it an insignificant number?
It's a relatively small number of occasions that we use the capital directive, because, as I say, we're
you work it out,
able to get it done through our other enforcement techniques.
Senator Bond.
Thank you very much, Mr. Chairman. I have listened with interest to the testimony and read the testimony that was presented before I came in, and I know that Director Ryan and Governor Angel talked about interest rate risk, and that brings me back to sort of a hometown question. Since I come from Kansas City, Director Ryan, it may be a little surprise to you that the media back there has raised a number of questions about the Franklin savings situation. And I know that the initial decision of the district judge has been stayed or temporarily withheld, but there has been a great deal of question about the accounting and the evaluation of that situation. I realize that you may be circumscribed in your ability to discuss a matter which is under litigation, but do you have some further thoughts or general principles which might be derived from the district court's findings and the situation as it exists in the Franklin Savings case?
Senator Bond, as you've stated, I think I do have to be somewhat careful because this matter is now, in fact, pending before the 10th Circuit Court of Appeals. As you know, the district judge issued a ruling last week which turned the institution back to its shareholders. We asked for a stay of that decision from the judge. He denied that request, and we appealed on an emergency basis to the 10th Circuit. They granted a temporary stay, and that stay could be made permanent or it could be lifted within the next few days, or at least within the next 10 days. I would like to make one comment. The ruling of the judge was as to a decision made by my predecessor, Chairman Wall, who made the initial determination, I guess at that time he was Director Wall, to place Franklin into conservatorship. As all of you will probably remember, this takes you back 6 months to one of my first time before this committee. That was clearly an issue on the table, the constitutionality of some of the Chairman Wall appointment to director, and part of the reason I know that the chairman moved that hearing along very quickly, which we all appreciate, was the need for us to review these decisions. So one of the first things I did was to review the decision made by Mr. Wall. I looked very closely at all of the relevant files. I, in fact, expanded my review, talked personally with at least 3 of the experts involved, retained by the OTS. I also talked with managers of some of the accounts retained by the RTC. And I came to the very firm conclusion, which I have today, that institution, Franklin, is appropriately in the RTC. And that position will not change. I think it's an extraordinary risk for the FDIC, and I am very hopeful that when we have a full hearing before the 10th Circuit, that the 10th Circuit will reverse the district judge in Kansas.
Any other question? Any other comments on the interest-based risk and the manner in which it was hedged there? All right. Let me move on to another question. Risk-based capital standards are being phased in, and as I understand it, they will apply a single capital requirement to all commercial lending. But we know that all commercial loans are not alike in the degree of risk which they entail. Do you think we should be pursuing efforts to get agreements to apply different capital standards to different categories or risk content of commercial loans? Mr. Seidman, Mr. Clark?
Well, I think that one of the great dangers of getting into risk-based capital is that it can move towards getting a different risk weight for each kind of asset, and it soon becomes so complicated that it almost collapses of its own weight. Now, the Fed had a system like that many years ago, and it finally got to be so difficult that they put it aside. And what that does illustrate, however, is that risk-based capital as we have it today is a rough approximation. It's 50% for mortgages, home mortgages. Well, you know, is that the right percentage or not? And there are other percentages along the way. All commercial loans are treated the same. Triple A's and triple D's are all treated the same. So it's a very rough approximation. I think it's a useful step. I'm pleased to have been part of putting it in place with the other agencies, but it is simply another measure.
Want to comment on that, Mr. Clark?
Senator, I would agree with Chairman Seidman. This is something that was thought about at the time, as you probably know, that the risk-based guidelines were being developed. It's whether there should be differentiations made among different types of credit risk in the loan portfolio. The problem that you run into is where to carve it up, how many categories to have, and what the dividing line is. And we simply, I mean, we all recognize that there is a difference in risk between a AAA rated corporate loan and a used car loan. But the fact of the matter is it's very difficult to figure out where to divide that, so all loans were put in a 100% risk weight, which means that they tend to balance each other. I would like to say, if I might, because this picks up on a point that I don't want to let be unanswered here, and that is this issue that 10,000 banks in America can lower their capital standards as a result of the new capital standards that we're proposing. To the extent that that is true with respect to risk-based capital in absolute dollar terms, that's right. But I think it is a real misrepresentation of what's really going on. If you stop and think about what risk-based capital does for you, I mean, we've already embraced risk-based capital. Everybody has enthusiastically gotten behind that and said this is what we want to follow. Now, if we don't believe in it, we can do away with the agreement, or we can adopt a leverage ratio that is so stringent that it has the effect of overriding it so that that the risk-based standards don't apply anymore. But I think we've all agreed, and you heard Governor Angel indicate that, and it's very true, that the risk-based approach to capital adequacy is in the forefront. All of the G10 countries have agreed that this is something that makes a lot of sense. I think you need to, when you compare the risk-based standard with the old standard that we're phasing out at the end of the year, you need to be very careful to remember that under the old standard, primary capital included the loan loss reserve, and you could meet, a bank could technically meet our leverage ratio and have nothing in its capital account except its loan loss reserve. Now, I think we all agree that that doesn't make a whole lot of sense, and that's been changed. I think it's also important to remember that under our current guidelines, off-balance sheet risk is not counted. All of the securitized assets, all the recourse that may be off-balance sheet does not have to have capital maintained against it under the current standards. Under the risk-based standards, those will all be brought onto the balance sheet and capital will have to be maintained against them. I don't want to let the opportunity pass without pointing out that it is misleading. It's comparing apples and oranges to say that the risk-based capital standards have the effect of lowering the capital for all of the banks in America, because they simply do not do that. And banks under our old rules have not operated at the minimums, and we haven't allowed them to operate at the minimums, and we're not going to allow them to do that for the most part under the new standards.
Might just see if there's any other comments on that.
Senator Bond, I agree with the previous statements that risk-based capital can become too complex. But not only could it become too complex, but it could get regulators into the area of judgment, which is the expertise of the commercial banking and other financial institutions. That is, this assessment of the amount of risk going with each loan is the attribute that makes one banker more successful than another banker. And so when we talk about minimum standards, we're talking about minimum standards that have been designed to bring the entire world's commercial banking system somewhat into more alignment. The Federal Reserve's emphasis upon risk-based capital was designed to recognize that we had some exposure in the payment system, not only to the capital position of U.S. banks, but also the capital position of other banks. in the compromise internationally, it appears as if some of the numbers are somewhat lower. Now, I would agree with Mr. Clark that in the case of the risk-based capital, some of our concern is that the risk-based capital standards itself may be somewhat on the minimum side. It's not just the 3% minimum leverage ratio, but the entire risk-based capital standard may not provide quite as much protection as we think is necessary for a banking system entering into a stress period. So our emphasis is upon capital increases. Now, if we could just wave a wand and have more capital in all these institutions, that would be a wonderful deal. But in a market-oriented system, franchise value has to go with the flowing of capital into these institutions. We've had to go easy in regard to getting what it is we want, which is more capital. Everyone knows we need more capital cushion. But we have to be careful that we not, in a sense, raise the standards in such a way that the capital markets would react by saying, we're not going to put any capital in those institutions. So it's a very difficult period that we're in. And I think all of us here are dedicated to the proposition we need more capital.
Thank you, Mr. Chairman.
Well, I think that's pretty strongly felt, strongly put point, and I think widely shared by members of this committee in terms of the urgency of getting the capital built up and how best to do that. I mean, the franchise value, whether we've got a franchise that is capital worthy and capital attracting and capital and can generate the earnings in the form of retained earnings and capital coming from that source is really a critical issue here. Comptroller Clark, I want to just cover, I want to go through this, one aspect of this a little bit further, and then maybe we'll stop at a second round here and then move on to Mr. Breeden. But last year, the GAO testified about your proposed 3% leverage ratio, and the GAO said, and I quote, "After reviewing the issues, we conclude that capital requirements should not be lowered for any banks in the process of converting to the risk-based capital standards." That opinion was based on 5 items, and let me just tick them off. The lack of experience with risk-based standard. Number 2, the increasingly competitive environment for banks. 3, banks should not be signaled that lower capital is acceptable. 4, risk-based standards do not cover risks other than credit risk. And 5, the FDIC's reserves are at historic lows. Now, with the GAO having expressed that view, now granted this was a time back, but it's directly on point here, how do we set those concerns aside here? It seems to me they're giving us a warning here, and when you say, and let me add one other thing to it. When you said earlier that you haven't issued very many directives, really very few capital directives, and that's because you work it out on a case-by-case basis, I take it. And so there's a kind of...
Or you order it done otherwise than through a capital directive.
Well,
capital directive is a specific kind of remedy. In order to,
here's my concern. I'm concerned about our ability to provide effective oversight as to what's going on and whether there's structural weakness out there and whether it's accumulating and posing a new level of risk to the system that we may not fully appreciate. You might see it, we might not be able to see it. We have an obligation to make sure we're doing everything necessary to be sure that we do see it. And even we might attach a different value judgment to it than you might. So we've got to have a way to measure ourselves what's happening here. And I would be concerned, for example, if we had big banks that were really showing an eroded capital position, and we're not getting capital directives, and things were being worked out some other way, and we might not even know about that.
Well, Mr. Chairman,
and I don't say that in an accusatory way.
I understand it, but I do think it's important for me to clarify for you the difference between a capital directive, make sure we're talking about the same thing. If you mean by a capital directive, the OCC as the supervisor telling a bank it has to get its capital up, then we issue lots of capital directives. But as you recall, the Congress gave the OCC and the other regulators a specific tool, maybe it was just the OCC as the primary supervisor, a specific tool called a capital directive that is focused solely on capital. And if you're talking about that as a capital directive, then we issue relatively few of them because most of our enforcement actions cover things besides capital. I would suggest to you that virtually every cease and desist order that we issue or every formal agreement that we enter into with a troubled bank includes a requirement that that bank raise its capital. But it also includes a whole bunch of other things, and that's what I meant by working it out differently. We direct them to raise capital, either by ordering them to raise it or by getting them to agree to raise it. But we don't use the remedy of the capital directive very often.
Well, I think the Congress would be inclined, and I can't speak for the whole Congress, but capital directive approach is a pretty clean and direct way to do it, and it gives us a chance to keep track as to what exactly may be going on here. And
Mr. Chairman, we can tell you just as easily how many of our enforcement actions that we've taken involved requests for increased capital. That's easy. That just because you use the specific tool called a capital directive is really not of any consequence.
how many of those would there have been, say, in the last 6 months or a year? The informal directives.
A lot, but I can't tell you.
Hundreds? Dozens? What's a lot?
More than 100 and dozens, more than 100, not hundreds.
Major institutions?
Major institutions, small institutions, medium-sized institutions.
And
When you read about a bank entering into a memorandum of a formal agreement with the Comptroller's office, or even a memorandum of understanding, or having a cease and desist order imposed on it, either by consent or involuntarily, I would say that 95% of the time that enforcement action involves, among other things, a request for an increase in capital.
I guess the thing that is of concern to me, and we've had a lot of hearings here, and the ones of you have been here on different aspects of this problem, namely what's the condition of our banking and thrift system, how strong is it, what problems do we have with the insurance funds, is capital adequate, are we building it, is the franchise properly designed, all these things tie together. The sense I have is that the insurance fund is just one bottom line, is under very severe stress, has been now for some time, and even with premium income coming in, the reserves are dropping. I see a hollowing out of real estate values across the country. I mean, it's happening region by region. Chairman Seidman has come in and with his map, which shows how that problem has been spreading. There's stories in the paper today about this particular region. There are very few regions that are exempt from it. And so you've got this hollowing out of balance sheet values and outstanding loan commitments and so forth, quite apart from what the justification may have been and looked like when loans were made sometime in the past. So we've got a kind of an economic erosion occurring underneath the system, and it now raises the question of whether or not the capital cushions that remain are going to be adequate to protect us from overrunning the reserves that are still in the insurance fund. And I have a real concern about that. And
I do too.
I think we're getting down to the point, and when I see a recommendation being made, and properly so, we talked about this just 3 or 4 weeks ago in here, to increase the insurance premiums being paid by banks into the insurance fund to the maximum under the law, and that's still leaving a question as to whether that'll give us a net addition in reserves or that'll just cushion, better cushion the rate at which the reserves are being drawn down. I'm not comfortable with the fact that we've got enough cushion left. I'm just not comfortable with it. And that's why I don't think we can fool around any longer in having outstanding issues on capital standards kicking around. I think they've got to be settled. And I think they've got to be settled because we've got to know what we're doing, and there's got to be uniformity, and everybody has to understand it. And if these things are that inconsequential, then they ought to be settled. And reasonable people ought to be able to sit down in a room and hammer it out and get clear signals out there to everybody so that everybody's marching to the same drummer. And we got enough problems over in the savings and loan system getting that situation stabilized that I don't think we can afford any fuzziness or ambiguity in what the standards are. And, you know, I don't know how else to say it, and I don't know, Senator Bond, if you've got a feeling on this or not, but that's my feeling. And so that's why when I said earlier, I thought that we ought to hear some commitment to try to get this thing nailed down in 30 days. 30 days is a long time, and especially when we've been at it for a better part of a year. And I'm hearing still some differences of opinion here. I think they got to be settled, quite frankly. Anybody want to respond? And otherwise, I'm going to move on to something else here.
Mr. Chairman, I still would, at the risk of sounding like a broken record, would just say one more time that where the minimum leverage ratio is, given the fact that all of us recognize that it is only the highest quality, best managed, least risky banks are going to be able to take advantage of it, is not the point. The point is the bigger one that you're making, which is for the other banks. Are we being diligent in requiring enough capital to protect the system and to protect the insurance fund? And no one can come up with a magic formula. No one's ever been able to come up with a magic formula that I know of that tells you, where that you can feed into a computer and tell you exactly how much capital you need to have. But I can assure you that based on all of the flack that I've been taking over the last 6 months from bankers about criticisms of assets and insistence that they get their capital up and that they get their reserves up, which under our new standards, as you know, depletes their equity capital. I think that we have made material progress in strengthening the capital test in the system, and in fact the numbers will show that you're getting more capital in the system. That's the point we need to be focusing on. As I said earlier, if you have a concern about whether we are in the process of our enforcement activities making requests of banks that are undercapitalized for more capital, we can provide you that information, because I think you'll find that we are.
I think we need to see that. I think we need to see that.
Be glad to provide it.
Let me just ask you, Chairman Seidman, I mean, you've heard me try to put into words my anxiety and uneasiness here, and I'd like to hear your response.
As I've said, Mr. Chairman, I think it's absolutely essential that we agree on capital standards. Not that we almost agree, or my standard really means what his says, but I won't agree to it. I think that is no way to run a government, and I don't think it makes any sense, and I've expressed that to Mr. Clark many times. We thought 4.5% was the right number, because that would ensure that 10,000 banks would not perceive that their minimum capital standard had been changed. In the spirit of compromise, we said, well, if you are in love with 3%, we will go along with your amorous intentions towards 3%, but that's only for the finest suitors. Camel 1, defined. There aren't any. So it really was an exercise that I tell you, I find very difficult to know what to say further now. I don't think that under any circumstances we should indicate to 10,000 banks that their minimum capital standard has been reduced. Maybe they won't change their capital, but of all times, under these circumstances, to be talking about why we have to have a 3% in there, because 3% has this great balance, which he at the in. We worked with the Fed to put 3% in. We came up with everything we could to accommodate Mr. Clark, and we haven't been able to do it. So I don't know what further I can say.
Before I go to Mr. Clark, and I want to do that, Mr. Angel, can you shed any more light on this at this point?
The Federal Reserve wishes to use our efforts to bring together some notions in regard to these unfortunately mentioned and highlighted numbers. We don't like emphasis upon the 3%. That leverage ratio is only designed for institutions that have such high quality assets that the risk-based capital doesn't really catch them, so their leverage ratio would fall below the 3. And since the Tier 1 and the risk-based capital for 1992 was 4, we felt that we could go with a slightly lower number without giving any indication that we view minimum capital as being desirable. We believe that in this period of stress that many people have learned, including those who are stockholders and managers of banks, they have learned that it pays to have more capital, and regulatory surveillance certainly puts a bank in an undesirable attitude. And so we want the capital to be brought up. We believe that everyone knows now is the time to have more capital. Stockholders know it. The money market managers know it. Everyone knows it. So we think that there's a consensus here that's in the making, and we're moving forward.
What if we were to go with the Fed proposal, as it's now been put forward, what's the disadvantage with that? Why can't we do that, Mr. Clark? I mean, what do we lose? Where's the harm if we go with that?
You can do that, Mr. Chairman. There are a whole variety of things that you can do, but let me just, and this is, we have analyzed or have walked through the analysis in some detail in our final rule as to why the one significant difference in what we are putting out and what the Fed has put out, and I maintain it's not a significant difference, but it is the only difference you can really tote up, is that we have not limited the banks to the Camel 1 rating. Once again, somewhat theoretically, but possible, that you would have a 1-rated bank that you would want to have raise more capital. Now, I recognize that's not too likely, but I don't see any reason why, and these are issues that I've discussed with Chairman Greenspan and Governor LeWare and others on the Supervision and Regulation Committee over at the Fed, and we finally just said, look, in the overall scheme of things, it doesn't make any difference. We'll put the Camel 1 rating in, you put the language in about the top-rated banks, the best managed banks, and so on, and we're really at the same point. I really am sorry that we're having to spend this much of the committee's time talking about something that is of not that much.
Let me tell you, we got a lot of other things to talk about, and if it were settled, we wouldn't be talking about it. But sitting here, we're hearing differences of opinion that sound to me significant. Now, they're not significant in your mind, they are significant in his mind. And I sense that they're significant enough in his mind that he's come up with a proposal, he representing the Fed, that is different. So,
well, the Fed's already out on the record. They've already adopted. The Fed has already adopted their rule. That's easy. Our rule is in the process of being cleared, or it would be out already done. I mean, the only one that isn't done is the FDIC rule.
The FDIC staff has recommended that we adopt the Fed rule as proposed, and I expect that our board will adopt that.
Well, what are the chances of my selling my idea that I'd like to be able to have you fellas back for a cup of coffee in 30 days and find out that we've wrapped this thing up and everybody's singing this from the same sheet of music?
Let's try.
Well, that's a start. Let's see if we can't get it done. Let's just see if we can. We got enough other things to worry about to have this thing hang out there any longer. Senator Bond.
Mr. Chairman, having had a little experience in running a government at a much lower level, I believe that one of the things that is absolutely imperative when you have a regulatory function or functions exercised by government is to enable the people who are regulated and those who are administering the regulations to have some degree of certainty as to what the rules are. And if you can't agree on a rule, then you're not performing your function. Some reason it comes back to me that Chairman Gonzalez said about a week ago that he felt it was time that we had one regulator for financial institutions and have one basis for issuing these rules and regulations. Now, I'm very much impressed by the caliber of the testimony, and I think that it represents the great deal of talent that the federal government has attracted in the financial institution regulatory area. But I'd have to say that if we come back 30 days from now and we still can't tell the industry that these people are supposed to regulate what they've got to do, that I may be joining sides with Chairman Gonzalez, so we can at least get some answers. But perhaps I'm missing something, and maybe our distinguished witnesses here would have some views on why the trifurcated or quadricated system that we have now makes sense. Would somebody like to
Well, I'd say that this disagreement is the strongest argument I've seen in a long time for Chairman Gonzalez's point of view.
Anybody else care to step up at the plate? It's a slow, fast, fat one. You want to take a cut at it?
I think we've talked about this as much as it needs to be talked
All
about.
right. Let me pursue something else that we have talked about today. We've talked about the very important issue of accounting standards and figuring out when an institution is in trouble. Implementing the remedies that are available is also very important. And Director Ryan pointed out that FIREA gave OTS authority for early closing, and if I'm not mistaken, Chairman Greenspan, when he was here about a month ago, said that the most important thing you could do is to close down troubled institutions while there was still some value in them, so it would minimize the exposure to the insured deposit fund. And I would be interested in hearing from Mr. Seidman and Mr. Clark whether they feel there is adequate legislative authority for such early closures, and if not, do we need additional legislative authority? Are you contemplating any changes in procedures, or do you see early closure as being a more important remedy in the future than it has been in the past?
Senator, I'd be glad to respond to that, since as a primary supervisor, we're in the role of the one that actually does the closing, at least of a nationally chartered bank. As I indicated in my opening statement, I think one of the most significant things we've done within recent time is change our definition of insolvency to say that instead of closing a bank when it is primary capital insolvent, that we will close the bank when it becomes equity insolvent, which means that at that point the loan loss reserve has been taken out of equity, and if there is no more equity, then the bank is closed and turned over to the FDIC as the liquidator with the loan loss reserve intact. We don't have enough history yet to tell exactly what difference that has made, but there have been some instances where the losses estimated to be incurred by the FDIC fund in the course of liquidating banks that have been closed on that basis are expected to be materially less than they would have been had the bank been left open until its primary capital was exhausted. I think the concept makes a lot of sense. The time the place that you get into a little bit of trouble is when you are taking, it's the issue of taking private property. If there still is value there, if there still is equity capital in the bank, it becomes a little bit more troublesome to step in and say, irrespective of that, we're going to take that away from the stockholders. It's an easy call when their interest in the bank is no longer present.
So my question is that too late?
Well, if I could say so, Mr. Bond, our look at it is somewhat different. That is, we can't close the institution, but we can withdraw insurance. We asked to have the power to do that in a very short period of time in FIREA. There was great opposition to that, and it came out as a compromise which improved our ability to withdraw insurance rapidly, but it still is clearly cannot be done as quickly as we think would be beneficial to the system. So if the Congress were to revisit that issue, you will be glad to remake the arguments that we made before, that we need to have that power and be able to exercise it in a very short time. On the other hand, I would just like to have the record show that closing an institution rapidly does not necessarily mean that we'll end up without loss. What we have learned is that when we close an institution, we lose value per se by closing it. And secondly, if the institution is not being badly managed, we simply transfer bad assets from the institution to the government, or to the government's responsibility, and the losses continue until those assets can actually be redisposed into the private sector. So once there's a built-in loss because there's non-performing assets, until those have run their course, that loss is built into the system. And I think the Congress may well have to take a look at that issue, and I've discussed it with Mr. Ryan in some depth as to whether or not it is useful to close institutions which are undercapitalized but are not badly managed in order to cut losses. I mean, I don't think it has been proven that that necessarily is the result. And we certainly have learned from our experience that once you close an institution, you lose going value, and that assets become worth less than they were the day before when they were in a going institution. So it's a very complex question. I just wanted to get on the record that it isn't just a simple answer, close them down and you'll stop the losses.
Mr. Chairman, I wonder if we could hear any further responses from Governor Angel or Director Ryan.
Yes, by all means.
Senator Bond, I think what Chairman Seidman has just said is so important. The economic going concern value may be quite different from the liquidation value. And so the notion that the going concern value has equity capital that's positive, and that then you then place the institution under the trauma of, in a sense, a closing, then under those circumstances you may find that the gap between the going concern value and the liquidation value can cause some exposure to the insurance fund. And that's why it's so important that the owner's equity in the institution be maintained at a level that the owner will engage in the corrective action which is in the best interest of the stockholders and thereby protects best the insurance fund.
Senator Bond, as you know, because obviously you looked at our written statement, we are in the process of finalizing an early intervention regulation right now, which probably will be submitted to Treasury within the next month. We find it not only important in the context of identification and early intervention, but also an important link to a program initiated by Chairman Seidman, which is the accelerated resolution process, which we hope will help to avoid some of the devaluation that has taken place within the conservatorship. And as I think you know, we're now about 35 or 40 days into a pilot project, and sometime, I'm sure within the next couple of months, the chairman will be in a position to present some findings as to that pilot project.
Thank
You
Mr.
know, if
Chairman.
I can continue on, I think this is a very important line of questioning, and it sort of takes us over into a somewhat adjacent and different subject. But if I hear what I think you're saying that this gets into semantics, but one of the words that's been used for a strategy like that is called forbearance. In other words, you may have a situation where you're better off to go in and forbear for a while to work it along, because if you don't, if you just drop the hammer, you may crash the values down from where they are to a lower level and end up taking more money out of the pockets of taxpayers who have to cover the losses. Now, with a history during the 1980s, you know, any notion of forbearance tends to be sort of automatically seen as unattractive and not facing up to problems and such as that. But what I'm also hearing you say, now that you've had experience in shutting down a vast number of institutions, that you may now be getting to a tier of cases where the judgment call may in fact look like it's one way, but if you track all the economics through, you might find out that you're better off structuring some kind of a workout situation so that you don't end up causing a catastrophic loss in additional value that Governor Angel's talking about, and that maybe you can actually end up spending less money going that route. Is that part of what I think I'm hearing you say?
I think we have to be talking about something except forbearance. So what we need is a new title
A
to
new
begin
word.
with the discussion of this subject. Of course, FIREA itself has a plan for, if you will, deferral of closing based on acceptable business plans.
Right, exactly. We spent a long time working that
We had a similar
out.
thing for agricultural banks. It did not apply, however, to insolvent institutions. It applied to institutions that were below minimum
Right.
standards but not insolvent.
Right.
I think that's an important difference. When you get into those that are solvent but are below standards, then I think you do get into a judgment area. And given the size of the S&L problem, which is vastly larger than any of us knew, it may be that we diagnosed this as a golf ball-sized cancer and now it's a basketball, and it may not be that the remedy is exactly the same. And so I think it's a subject worthy of study. We have been discussing that in depth with Director Ryan. There are certain things that we think require further study. The accelerated program moves in that direction. And I think it's to every extent we can avoid forcing more real estate onto private sector markets right at this time, the better off the taxpayer will be in the total cost of this.
Well, you know, it looks that way from what just one reads in the tremendous flow of news accounts that this very significant drop in real estate values, residential values, commercial values, pretty much across the country has added a whole new dimension to this problem, because you have in effect a kind of workout situation. Now, if somebody's clearly insolvent, that's one thing, but that tier that perhaps could make it on through and not become a burden to the taxpayer falls into a different category. But it sounds like we now have these new economic conditions bearing in on this, and what I hear you both saying with carefully chosen words is that maybe there's some way here that ought to be looked at that can reduce these ultimate losses to taxpayers. I mean, that's what I hear you saying. Now, I don't know how we capture that problem fast enough to be able to wisely and prudently consider doing something like that. But I can tell you that around here, and I'm sure Senator Bond would agree, that with your statement, Chairman Seidman, that the scale of losses is going beyond what anybody imagined. I mean, it's just, you make the point that even from your own point of view, it exceeds anything that was
Well, it's continuing
anticipated.
to increase, because
Exactly.
every time we estimate losses now, we're looking at lower real estate markets, which means the losses are higher.
Well, I would certainly, you know, we'll meet at any time to sit down in a setting like this to hear any recommendations or proposals anybody wants to make. I'm not sure that, I don't think we're equipped to initiate those from a cold start. I think we would need to have really a professional view from yourselves as to what adjustments might be needed that can reduce losses. And if you have that kind of a proposal, I'd also want to, you know, have the administration's viewpoint on that, and would assume that that would be something they'd be very much interested in as well.
We have suggested this, Mr. Chairman, as a subject for study to the Treasury, and we are doing some work in that regard now. And we are looking for what we might think could be recommended and a new title for it. And as soon as we come up with that, we'll be back to talk with all the parties involved.
Mr. Chairman, I wish he hadn't extended that invitation, because I had decided to resist the temptation to suggest that this deferred regulatory intervention program, or DRIP, be initiated to avoid the flood of properties on the market. And I had almost won over, but my better judgment was overwhelmed by that invitation. But I think that what Mr. Seidman has suggested is that while early intervention and closure generally may be a good rule when there is not a situation like we have today with the tremendous burden of real estate overhang on the market and a real question about the adequacy of the funds available for early closure, then there is a very difficult and tricky regulatory path to follow. And if you follow it well, nobody will notice, and if you don't, you'll know that we will criticize you very severely for not having steered the right course, but we do wish you well.
Thank you, Senator, and we will need all your good wishes. I just want to bring out that we are talking here about carefully supervised management, and whether it is in one of these institutions or in the RTC may be something that can be evaluated to see which kind of carefully supervised management might produce the best result in terms of cost for the taxpayer.
Well, and I want to add one other thing for the record, because there's a second level cost here that's a little harder to see, and that is that the more we pour assets into the RTC, real estate assets, commercial or residential, whatever they happen to be, I mean, here we sit as taxpayers now with this great big collection of repossessed assets, and the more that come flooding in there, in a sense, the lower the value tends to go for all the assets. And now those asset values are our asset values as the general public. And so in a sense, you know, we don't want to devalue our own assets any more than we have to. I mean, we're talking here about some kind of a more orderly liquidation process, or a leveling out process, it seems to me. And because in the end, what we want is value back. We're trying to retain value and retrieve value, and it's I think, as Senator Bond says, it's a very, very difficult task, and I'm not sure. I think you almost have to start by saying there's no good answer. The question is what's the best of a poor set of answers, and we don't want to inadvertently take the worst of a poor set of answers and end up driving up the cost without thinking through you know, the relationship of all of these things one to the other. So I think you're hearing a bipartisan interest in wanting to listen carefully to any thoughtful proposal that regulators feel is appropriate to consider, or that the administration would feel is appropriate to consider. And you know, we want to help you get your job done. Thank you very much. Thank you. Thank you. Let me now invite Chairman Breeden to join us.
We will use this.
The committee will come back to order, and let me give a special welcome to Chairman Breeden. We're delighted to have you with us today. We have been underway about 2 hours. We thought we might get to you a little sooner this morning, but we especially want to hear your views. We'll make your full statement a part of the record, and I want you to go to the summary points that you think are most important for us to hear. And also, I know you were able to listen to some part of that previous discussion, and anything that warrants comment on your part from that discussion, I'd invite that as well. Clearly, the Securities and Exchange Commission plays an important role in ensuring that full and accurate disclosure is made by companies that issue securities into the hands of the investing public. Many people question the value of today's accounting standards based on historical cost rather than market values. And this issue, as we have just been hearing, is critical for banks and for thrifts and for other institutions that deal in financial instruments, and particularly when we have the taxpayer at risk in terms of an insured deposit system that's the foundation of the way our entire financial structure is based in the world of banking. So we very much look forward to your remarks at this time, and we'd be pleased to hear from you now.
Thank you, Mr. Chairman. It's a pleasure to be here, and I did enjoy having the opportunity to listen to the earlier discussion, which I think covered a number of very important points. I'm pleased to be here this morning to discuss accounting principles utilized by financial institutions. I certainly hope to respond to the committee's inquiry on this most important subject in several important areas. First, I'd like to touch briefly on the role played by accounting principles in the growth and ultimate collapse of the thrift industry. Second, I'd like to review how certain of the specific regulatory principles, accounting principles or RAP accounting, and inappropriate or unique interpretations of generally accepted accounting principles or GAAP accounting adopted by thrift regulators facilitated the distortion of capital levels and the dramatic growth of the thrifts. And finally, I'd like to discuss the extremely significant issue that the committee has raised regarding market-based accounting and its bearing on the proper role of financial accounting for financial institutions. This committee has reviewed the history of the disastrous problems of the thrift industry. As you know, the thrift industry at one time was largely composed of small mutual institutions that were essentially incapable of rapid growth. The enormous expansion of deposit insurance in 1980, coupled with the removal of interest rate limitations between 1978 and 1982, changed the basic characteristics of the thrift system. In terms of the industry's ability to raise deposits to fuel a dramatic expansion of lending and investment, what had been a horse and buggy was replaced by a jet with afterburners. Appropriate capital requirements were one potential source of discipline. They would have served both to assure that thrift owners risked some of their own money in the loans they made and to provide a cushion against losses. More importantly, a meaningful capital standard would have served as a check against uncontrolled growth by individual firms and by the industry as a whole. Instead, the thrift industry was permitted to engage in unchecked expansion. Starting in the 1970s and continuing into the mid-1980s, federal thrift regulators consistently acted in a manner that eroded and reduced effective capital requirements. In November 1980, for example, the Home Loan Bank Board lowered the minimum net worth and reserve requirements that thrift institutions were required to satisfy from 5% to 4%. It further lowered that requirement to only 3% in January of 1982. Thus, at the same time that the thrifts obtained vast new abilities to raise deposits, the Federal Home Loan Bank Board acted to increase industry permissible leverage from 20 to 1 to over 33 to 1. In practice, the discipline that might have been provided by even 3% capital was significantly eroded by two other policies then in place. These were known as the 5-year capital averaging and 20-year phase-in provisions. Whatever their original rationale, these provisions helped lead to disastrous results. The 5-year averaging permitted thrifts to base the calculation of their minimum net worth and reserve requirements on average liabilities and deposits over a 5-year period rather than on the current year's liabilities and deposits. This method of computation drastically lowered the capital requirements for those thrifts that were expanding most aggressively. For example, under 5-year averaging, if a thrift with liabilities of $100 million in deposits took in an additional $100 million in deposits in the year 1983, or a 100% growth in a single year, it would have been required, by virtue of the averaging, to have only $1.16 million in additional capital, rather than the $3 million it would have been required to have if it were not for averaging, and the $5 to $6 million that it would have been required to have had it been a bank. If the thrift decided that that result was too good to be true and decided to take in an extra $1 billion in deposits rather than only 100% growth, and 1,000% growth at that period of time was not unheard of in the industry, it needed only $9 million in capital in order to support an increase of $1 billion in deposits and new loans. That's compared with the $50 to $60 million in capital that would have been required for a bank to take $1 billion in new deposits. In addition, the thrift could lend out that $1 billion, and because of the permitted booking of loan origination fees, the thrift was allowed to take 2.5 points immediately into income when it lent out those loans, irrespective of how risky the loans were.
And even though the loans in the future might go totally down the drain,
Absolutely.
they've got the front end, they could book the front end profit.
Irrespective of risk. So for $9 million, you could go out and get $1 billion, lend it out to anyone, and book immediately a $25 million profit. That was a treatment that was found most attractive by a number of institutions, and that was made possible by the combination of the averaging rule on accounting, low capital levels to start with, and the ability to book upfront origination fees and take them immediately into income, irrespective of the possibility of whether the loan would ever be repaid. The 20-year phase-in provision also had an impact in the effective capital levels that thrifts had to have, and this impact was most dramatic, applicable to newly chartered thrifts. Under the 20-year provision, thrifts had, a newly chartered thrift had 20 years to inch its way up to the full capital requirement, whatever that requirement might be, such as the 3% rule. So in any given year, in year one, a thrift, newly chartered thrift, only had to have 1/20th of the 3% that it was ultimately required to have. Well, when you work through the requirements, the new thrifts were able to have a leverage ratio as high as 666 to 1 when they were created, and over a 20-year period, they would get themselves down to a mere 33 to 1 leverage that other thrifts were permitted to engage in. And we have some charts at the back of the testimony that try and depict graphically the hyper leverage that was utilized. The outright reduction of capital requirements, when combined with the use of overly permissive accounting practices, permitted thrifts that were teetering on a shrinking or non-existent capital base to engage in high-velocity expansion. Indeed, from year-end 1980 to year-end 1985, aggregate thrift assets grew by almost $500 billion, from $621 billion to over $1.1 trillion. During the same period, wrap accounting permitted capital to be shown as increasing by about 45%, but aggregate industry tangible capital fell more than from $32 billion to only $8.7 billion, or so that while wrap accounting makes the capital look like it's rising, in fact it was plummeting. And in only 5 years, taxpayer contingent risks grew more than 72%, while tangible capital fell about 75%. With virtually no capital at risk, the operators of some of these thrifts had nothing to lose and everything to gain. The availability of deposit insurance was, of course, critical to the ability of these insolvent institutions to continue to attract funds. Whether financial regulators should have permitted the continued operation of troubled thrift institutions, the forbearance question that you were raising with the earlier panel, is a separate question from whether regulators, irrespective of any forbearance policy, should have fostered accounting principles that had the effect of creating the appearance of net worth rather than the reality of that net worth. If a decision is made to forbear closing institutions due to an expectation that change in the economy or other factors will permit their recovery, that decision should at least be made openly.
I might just say, I don't want to interrupt the flow of your testimony because I think it's excellent, but you know, we even saw the development of net worth certificates during that period of time as part of exactly what you're describing.
And conceptually, the net worth certificates is a better approach, it seems to me, in the sense that it would be better to acknowledge an insolvency, acknowledge the gap, and then say what policies should be in effect during such period of time that we're deciding how to work out that problem institution. And if it requires a certificate to bridge the negative net worth, better a certificate that has to be recorded every year, and where Congress and the public know how big that gap is, than cooking the books in a way that makes it look like there's net worth when in fact that net worth doesn't exist. Now, of course, if the certificates themselves are allowed to be used as a basis for growth, that would be another matter. But certainly the recognition of the size of the hole, rather than concealing the depth of the problem, would, I think, have been a much superior approach. Instead of that approach of recognizing the size of the loss and recognizing the size of the solvency problem, accounting principles were modified in a way that allowed the insolvent institutions to appear to have positive net worth, thereby creating, in effect, a stealth balance sheet. By creating an accounting facade that was like a Hollywood movie set, the front of the building and perhaps some sides, but nothing else, net worth suddenly appeared out of what was in reality a sea of insolvency. The committee's letter of request invited us to discuss the differences between wrap and gap accounting principles and also whether the thrift problems resulted from inappropriate accounting standards or rather from a lack of enforcement. These two issues are related aspects of the problems created by modifying accounting standards to create the appearance of solvency among institutions that in economic fact were not solvent. Sadly, unlike the fabled emperor's new clothes of children's stories, the thrift accounting standards did conceal the underlying reality from most observers. Indeed, the appearance of earnings and solvency was used to justify not only expansion, but also dividends, enormous salaries, acquisitions, opulent and indeed at times repulsive corporate lifestyles, and many other expenditures that drained cash from failing firms. The most legitimate justification for the use of WRAP is to require more conservative reporting of earnings or net worth by a regulated firm than GAAP might be interpreted to permit. However, the actions of the Federal Home Loan Bank Board during the period we are reviewing relating to WRAP were designed to permit the firms overseen by the Bank Board to report an inflated net worth compared to that permitted by GAAP. During the 1980s, thrift WRAP were significantly more liberal than generally accepted accounting principles. For example, thrifts were permitted by WRAP to employ accounting techniques whereby they could utilize what was known as appraised equity capital, which was nothing more than selectively writing up the value of certain assets that the thrift may have owned, such as buildings. And while my testimony later will indicate a general strong preference in favor of market value of assets, the difficulty here was the ability of thrifts to pick and choose those assets that would be revalued on the basis of market, and only the gainers were marked up and not the losers. Secondly, as we already mentioned, loan origination fees could be immediately recorded into income, whereas under GAAP they would be required to be fully spread over the life of the loan, and if the loan was not repaid, the remaining origination fees would not be includable in income. The third item was that losses on assets sold could be treated as an asset included in net worth, subject only to amortization over the contract life of the assets. This was an enormously significant policy, and one I think that is dramatic in the degree to which accounting principles diverge from economic reality. What this principle said was that if you had a portfolio of $500 million in loans and it had declined in value and was sold for only $350 million, resulting in a loss of $150 million, GAAP accounting would say that when you sold the loans, that $150 million loss has to be recognized. Instead, under WRAP as practiced in the thrift industry, it's $150 million of loss. This is simply a loss. That loss was allowed to have the word asset hung over it, put on the asset side of the balance sheet, and the thrift was able to report that it continued to have $500 million in assets, in this case the $350 million cash from the sale and $150 million of deferred loss. The treatment of your accumulated losses as assets, which could support loans on your balance sheet, is a very curious idea, one that was so curious as to be extraordinarily popular. Indeed, through 1985, when the practice finally came to an end, $6.3 billion of accumulated losses got treated as capital. That was enough to support $209.7 billion in new loans backed solely and completely by your accumulated prior losses.
But let me just stop you right there, because I think to the citizen sort of trying to make sense out of this or looking in, how could something like that happen? How did that happen? I mean, just what you've said so far, just the pile-up of those kinds of accounting treatments, what drove that?
Well, I think the supervisory authorities were concerned about the fact that institutions had low-yielding assets on their books, and so that at a time in which their cost of funds might have been 8%, let's say, their loan portfolio might be yielding only 6%.
Now, may I stop you again just for a minute here, because I really want to get this, I want to make sure the record covers this. And part of that, was it not due to the fact that we'd had this enormous increase in interest rates, and you had a lot of the traditional thrifts with these fixed-rate mortgages at a much lower interest rate, and so when interest rate ceilings went off, which you mentioned, and the fact that interest rates themselves during the early 80s went up to very high levels, you had a situation where you had probably a nominal failure in a lot of these institutions because they had lent long at a low interest rate, and they were now having to get deposits at a new high interest rate. And was that the principal cause or not, in your view, at that stage? I mean, I don't try to say at all that there was a single cause, but what would have given rise to that burst of phony or creative accounting that you've been describing?
Well, you're correct that going back in history, the thrifts had traditionally been restricted to essentially one product, the mortgage loan, and that had traditionally been made on a fixed interest basis. In fact, throughout the late 1970s, policy at the Home Loan Bank Board was to very strongly discourage and, in fact, to not authorize the making of adjustable rate mortgages even by those institutions who saw the interest rate mismatch coming. So you had an entire industry that, because of the inadequate diversification of its asset portfolio and because of its dependence on the fixed rate mortgage, was essentially making a giant interest rate gamble. And when, in the late 1970s, when interest rates skyrocketed, the thrift institutions were rendered, many of those institutions, on a mark-to-market basis.
Right.
Not the carrying value, not the historic cost of those mortgages, not their face value, but if you looked at their true market value, those institutions were insolvent. In fact, in a very good study of this problem done by Professor Ed Kane out at Ohio State, he reflects, and it's cited in our testimony, that in his estimates by 1978, on a mark-to-market basis, the industry probably had an aggregate negative net worth of about $35 billion, ranging from $35 to $50 billion, and that by 1980 that had probably grown to between 78 and 120 billion in losses. So that situation occurred. Now, the regulator...
But before you go any further, because you've just said something that's very important, and I don't think 1/20th of 1% of the public or anybody else that even pays attention to this issue understands what you've just said or knows that to be the fact. What you've just said is that the S&L industry was insolvent and had overrun its insurance fund back in 1987, between 1987 and 1980, but for a variety of reasons, some of which you've just recounted in detail, all of the creative and phony accounting and so forth. It was not until 1989 that issue was put on the table, as you and I are as familiar with as anybody, because we both were involved in writing the reform bill and drafting it and getting it done. But the cold fact of the matter is that a decade earlier, full decade earlier, the industry had gone into the tank. I'm not sure that was generally understood even at that time. I mean, it's a lot easier to do these reconstructions after the fact than at the time. But as you sit here now professionally, I mean, isn't it a fact that the industry was insolvent in 1978, 1979, 1980?
Yes, I think all the studies of the thrifts and their portfolios, looking at the value of those portfolios at then market rates of interest, would have to conclude the thrifts were insolvent on an industry aggregate basis. Now, there were some thrifts whose portfolios were matched and didn't have this problem, but on an industry-wide basis, the thrifts became insolvent sometime in the probably mid-1970s. And indeed, I recall that the Hunt Commission report that was impaneled by President Nixon and issued its report back in the early 1970s, 1972 I believe it was, said that one of the most important problems facing the nation's financial system was the crisis in the thrift industry. So this was certainly a problem that was brewing throughout the 1970s.
As the Hunt Commission said that in 1972, and we didn't get the reform legislation that really dealt with all these problems in place until 1989. Boy, that's not much of a favorable commentary on the speed with which government works, is it?
Probably not in general, although the Hunt Commission was not, when they said that, was talking about a range of problems, including inadequate asset authority, inability to pay above the Reg Q ceilings,
of course, all those
a range of factors.
Yeah, well, we did all those
which
things.
Were addressed.
Yeah, all those things came along in the 1980s, and instead of solving the problem, as you yourself have just testified, because of these other factors that were at work, made it worse. Made it worse. I mean, there was the deregulation, and we opened it up, and we got rid of Reg Q, and then we came along because we had an embedded financial problem of enormous consequence already. And we used phony accounting and a lot of other things to hope that over a period of years there would be a workout, and that in fact the industry could get out of the hole, and in fact it dug a much bigger hole for itself. Isn't that basically what happened?
Well, I think there was a sustained period of time in which the industry and its regulators continued to think that prayer and good thinking and forbearance would ultimately that someday the tide would subside and the things would get better, and unfortunately things got worse. I do want to make one thing clear, is where we're talking about the accounting principles and those that were, shall we say, inappropriate interpretations of GAAP, and those that wrap principles that some would characterize as phony accounting. The absence of mark-to-market accounting in the late 1970s, the difference between the minus $120 billion that Professor Kane says the industry's aggregate net worth was in 1980, and the positive $32 billion that the Home Loan Bank Board statistics said that it was at in 1980, was not phony accounting, because that's based on the difference between mark-to-market accounting and historic cost accounting. And GAAP accounting permitted those institutions to reflect their mortgage portfolio on the basis of face value and cost rather than on the basis of marking it to market. So in that respect, what concealed the disastrous problems in the thrift industries in the 1970s was not manipulation of GAAP per se, but rather was the unwillingness to recognize actual current economic value. That then was exacerbated, and just at the time that some of these new tools, including the freedom to bid for deposits with unlimited interest rates and the asset diversification, that came along at a time when these institutions, a great many of them, were already insolvent. And so I think the problem was not necessarily that it's wrong to allow flexibility in the interest rates that are paid, and certainly the problem isn't that it's wrong to allow diversification in assets. That generally reduces risk rather than increases it, but rather that when some of those things are being done by firms that are already insolvent, then you can experience very great distortions in the results that will occur. And sadly, that was the fact that the institutions themselves knew that they were insolvent, because managers of financial firms, irrespective of what the accountants require to be carried on the books, at least those that are even mildly competent, know what their own current market value is. And if it's substantially below zero, if they are in effect insolvent, then they have every incentive to take big risks in hopes that they will recoup those losses, and knowing that if it's really the old heads I win, tails you lose, I can take in new deposits, make loans at much higher risk. If those prove to be successful, the benefits will accrue to the institution, and it may claw its way out of insolvency. And if there are losses, well, that's the problem of the insurance fund. And since the institution had no real equity at stake at any point. But it is a combination of the distortion, enormous distortion, in a fluctuating interest rate environment that cost accounting causes, coupled then with specific steps that the bank board took, such as deferring the recognition of loss, which GAAP would not permit, and that was a divergence from GAAP. So you had both items.
Well, let me just ask you something else at this point. Now, to a citizen sitting out there today who's trying to make sense out of all of this, trying to make sense out of what's happened in the last year, or the last 5 years, or the last 15 years, or even going back to as early as the Hunt Commission in 1972, the taxpayers being told and presented with a bill to, in effect, through government, to come in and help make up for the deficiency in the Savings and Loan Insurance Fund. And so the citizens sort of looking at all of this, and if they were listening to this conversation, would say, you know, if this thing has been in the making for 17 years, in effect, as we've just been tracing the history, and it really was gathering momentum in the late 1970s and crossing over into the next decade, and then picked up steam through the 80s, and then all of the creative and phony accounting getting layered in on top of it, so other things we've just talked about. I think they would, a citizen trying to just get to the bottom line of all of this would sort of say, well, how could it be that there could be, in a sense, one assumes a kind of general consensus that was the way to do it at the time? In other words, you have an awful lot of parties of interest when you think about it. You've got regulators, you've got Congress, you've got the industry, you've got the private accounting profession, you've got any number of people who are the legal profession, all of whom are sort of parties of interest in this whole area as you're coming down through this period of something close to 2 decades. But even if you just take the last decade as the time when things really continued to mushroom in size. And I think the citizen is likely to say, how could it be that, you know, with so many parties of interest and all, you know, pretty savvy players in all of this thing, that it could not be seen that we were on a track that was going to lead to a very sad end. And what would be your response to that? I mean, how could that be?
Well, I think there were several factors, and one certainly that was very significant. I don't want to overstate it, but I think its importance has probably been not well understood, and not understood nearly as much as it should be, is the impact that these accounting rules have. Because while it's fair to say that there are a great many people whose interests are affected, and certainly the taxpayers who stand behind the insurance funds should be first on that list, but certainly other regulatory institutions, the Congress and other groups, have interests that are affected. But you have to remember that there are thousands of institutions that are putting forward a financial statement, a balance sheet, an income statement that shows that they are in the pink of health. There's the capital, it's this level, it's rolling in every year.
Numbers all add up.
And I don't think that you can expect, certainly those of us who are not trained accountants, are not typically in the habit of going back, and particularly where financial statements of that kind have been overseen by a primary regulator whose job it is to make sure that those accounts are accurate, and to question the fact that if the accounting statements show $32 billion positive, when in fact, in economic fact, there's $120 billion to the negative. It's the ability, it's the decision to allow the accounting rules to be used to cover over and obscure from public oversight the size of the problem. And in this case, the bank board had a fair ability to, on its own, make those decisions. One of the things that I'll mention later and is described at length in this testimony, and I know this committee is familiar with the long-standing view of the Securities and Exchange Commission, endorsed, I might add, by all the federal financial regulators in 1985 as a recommendation of the Bush Task Group, is that the accounting statements and disclosures that are made by institutions that are selling stock to the public should be overseen in all cases by the SEC and not by the specific regulator of that firm. Now, the SEC has jurisdiction when every type of public company goes to market in the United States, about 11,000 public companies. We review the prospectus for every one, except banks and thrift institutions that aren't part of holding companies. In that case, it's the specific regulator, the FDIC, the OTS, the others, that look at those prospectuses. So at this period of time, not only are these accounting principles and statements being reported to the regulator, but they're also being used on the basis of hundreds of public offerings of securities, and those offerings are being overseen not by the SEC, but by the Federal Home Loan Bank Board.
Unless a thrift or a bank is part of a holding company.
Was part of a holding
and
company.
You do get
and holding companies are very common in the banking industry, and in fact we oversee the offerings of virtually all the large institutions by virtue of that. But holding companies were relatively uncommon in the S&L industry because of the fact that they're powers to have service corporation subsidiaries, and their asset powers in the S&L or in an S&L subsidiary were much greater. They really didn't need to have holding companies. So in the S&L industry, most of the offerings were in fact occurring under the bank board rather than the SEC, and that reinforced this. It prevented the opportunity, at least. I can't say how much whistleblowing would have happened had those filings occurred over at the SEC, but there at least would have been a chance that someone else, another point of view would have been brought to bear. Someone else would have had an opportunity to second-guess those decisions. And I know Senator Wirth has a bill that has been introduced to accomplish this purpose, and that's legislation that we would still strongly urge that the committee take up, and would be of great improvement in the existing system. So one reason, but to go back to your question, is simply that the rules obscured this. And
let me just say before you go any further that your points are exactly right, although some of the most celebrated notorious cases that we know about in the thrift industry, in fact, were looked at by the SEC and under the control of the SEC with respect to their clearance processes.
that is true. I'm not going to sit here and say that...
and I'm not asking you to, because you weren't there at the time in any case. I'm simply making the point that even with those instances where the SEC did have an oversight responsibility, it looks to me as if the SEC itself was misled by some of the accounting standards or some of the representations made.
Well, just, if I might correct your view on that just a little bit. We took some positions. Well, I say we, the agency at that time, took positions that were different than the bank boards. For example, the bank board was permitting up to 40-year amortization of goodwill on acquisitions, and the SEC simply flatly refused to allow 40-year amortization, and advised all thrift holding companies that 20 to 25 years was the maximum that they could use, period, full stop. And that simply was the decision of the agency, and refused to allow what it regarded to be as unjustifiably long amortization periods. We also took action in the Financial Corporation of America case, where the institution, then by far the largest thrift institution in the country, was engaging in very speculative, what they called dollar rolls, and which were essentially forward commitments to buy securities, had booked $155 million worth of income on these transactions that was inappropriate under GAAP accounting in the judgment of the Commission. And it was the SEC that forced FCA to go in and restate its financials, take out the phony income, and that in fact triggered off then a run against a liquidity problem for FCA. Ultimately, the institution was closed and had to be recapitalized, but it was the Commission that took action in that case. We've brought cases against Continental Illinois, First Chicago, Southwest Bank Shares, a very large number of financial institutions that did report to us. And I might add that some of the cases that occurred over the last few years, the statute of limitations has not expired yet, and we are actively investigating, and there will be some other cases that will be filed in some of these instances to which you refer. So that I think we are dedicated to a good, sound, and tough set of accounting principles applied nationwide.
As an advocate of yours, in terms of your confirmation before this committee, I'm convinced of that, and you've shown that leadership since being at the SEC and before. But with respect to other things that the SEC does, you've given us some cases that go back into the early 80s and some things that were done. I don't know how many there would have been sort of in the later 80s, but I am right in understanding, am I not, that the SEC would also have to clear any bond sales by S&Ls that were part of holding companies, would they not?
Well, clear in the sense that if it's not an exempt transaction, if it's a public offering, then the prospectus for that offering would be filed with the SEC in the same way if it was equity.
The 11,000 you talk about, or what have you, that you have to do. So
that's correct.
But even there, the SEC, presumably, I mean, you're not going to do a perfect job. You try to do a perfect job. But again, doesn't the SEC have to rely on the accounting that's offered with respect to what you're given, or do you do an independent accounting assessment of documents you're given that fall into that category?
Well, we don't review exhaustively every filing with us, but we do selectively review documents, and in fact, initial public offerings, for example, we review all of them. Repeat offerings, we sample periodically, but we look for both at the text of the disclosure and do an accounting review. And there are many occasions in which we will not permit accounting that we believe is not sufficient with respect to Regulation SX, our accounting rules, GAAP accounting, that we can prevent the institution from going to market. In the case of depository institutions, the typical kinds of problems that often arise may relate, for example, to the size of loan loss reserves. That's a particularly frequent one. And there you have a situation in which we have to understand that these institutions do have a primary supervisor, and it's their job, not ours, to decide what percent of a given loan portfolio needs to be reserved against and needs to be written down. So that I think there is a somewhat of a tension, if you will, in that we would not want to second guess in an inappropriate way the decisions of the primary examining agencies as to the level of loan loss reserves, which has a huge impact on net worth and earnings.
Are there any examples where the SEC gave an approval, for example, to the sale of bonds for banks or thrifts, where in fact we later learned that the numbers were phony and the people lost their money? I assume there have to be some cases like that.
Well, there are certainly a number of cases in which subsequently the companies encounter problems, and I would not want to suggest they're limited to the banking and thrift industries.
Right.
Let me just make one small caveat so that people do appreciate the system that exists under the securities laws is that offerings are made by the issuers. We do review them. If we note a problem on the face of the filing, we can take action to restrain it. But under the law, the institution is free to go to market unless we can prove in court that the offering is being made on the basis of fraudulent information. So while we have an ability to comment, we have an ability to delay, and of course institutions sometimes do not wish to provoke us into bringing actions against them and highlight their problems. They usually prefer to correct the filings. We don't approve each issuance of securities before it's made.
No, but you go over every single prospectus. That's what I heard you say before.
No, we don't even review every prospectus. We do selective reviews. So in certain types of transactions, like initial public offerings, we review every one of them.
I see.
In other things like bond offerings, they're filed with us, but if it's the 10th offering of securities in an 18-month period, we don't always review fully, give a full review to every filing that's made with us.
If it's the first one, do you do the review?
Well, usually in transactions that are the first of a type or we have some targeting methods that we use to try and focus our review on the offerings that are most significant. But what I'm getting
to, though, and I think you've just said it, and if I don't have this right, correct me, and that is that when you go through the review in a situation where a review is warranted, and you have a very substantial review capacity, I mean, that's a very important part of what the SEC does, you still, for the most part, are relying on accounting information that is given to you. And I assume that I mean, you can't in each and every case go out and employ a separate accounting operation to go out and check and see if what's being certified by a certified accounting firm is or is not accurate. I mean, there has to be some basis upon, I mean, what sets off the red lights? What sets off the alarm if you see something that doesn't look right? If an analyst is going through a filing and sort of reads it carefully and so forth, presumably they're putting some very considerable reliance on the numbers that are presented. Isn't that correct? I mean, what sets off the alarm bells?
Well, if I can first agree with you in the general proposition that yes, we do rely very heavily on the fact that you have independent accounting firms, and in fact Firms that are issuing securities are not required to have an underwriter. They're not required to have outside counsel, but the one party that is required to be a part of any offering of securities is an independent outside accounting firm. So we do rely on the fact that there are audited financials. In the case of a bank or a thrift, in the case of a filing by a holding company where the principal assets, the principal earning stream is coming out of a regulated bank or thrift,
Right.
in addition to relying on the fact they're outside accountants, the fact that the financial statements of the bank or the thrift have been presumably carefully examined by the OCC, the FDIC,
Right.
the Fed, whichever agency has responsibility, is also a factor
Right.
that's very important.
Right.
That is not to say that we don't reserve the right, if we find a problem or if we disagree with the treatment that is involved, as we did in FCA, where the bank
Right.
board tolerated the dollar rules and where the SEC said, we're sorry, we can't live with that treatment, and we believe a restatement of results is required, we will act on that. But there is, in the general course of things, a great deal of reliance that we place on both the underlying regulator and the accounting firms in looking at the financials.
Well, I take the time to do that because it very importantly illustrates what you're here to talk about today, and that is that if the accounting treatment and the accounting information, I'm not talking about just deliberately doctored information, but if the underlying makeup of the information is unreliable or unsound, the system can't work that way. In other words, it seems to me if we don't find a way to address that and get to real accounting and to real market values and to have an iron discipline in that area, we're going to have any number of accidents waiting to happen, whether they're deliberate or not deliberate. The fact is that a system that is built on those kinds of practices just can't work right.
Well, I think I would agree completely that a system that is, and I do have some comments later on the general subject of mark-to-market accounting, but I think that particularly in financial institutions whose portfolios consist of financial instruments that have a readily ascertainable, in most cases, value, certainly in the securities portfolios, it would be regrettable if we continued to have accounting statements that essentially needed to have at the top of the balance sheet the phrase, once upon a time.
Yeah, that's right.
And maybe in a galaxy far, far away. I mean, we know what's important is what is the economic worth of this institution, not what did it once look like whenever it made investment decisions on its portfolio, perhaps many, many years ago. That is really a very, other than to historians, is of relatively little importance. Certainly is not of importance to investors or to the FDIC, the insurance funds, that will incur losses based on market value, not on cost, the carrying cost, original historic cost of assets. But we certainly are, and I would also agree that we are dependent, we are affected very much by accounting policies and accounting decisions that are made, interpretations of those policies, by the specific regulators in the bank and thrift area. Not only when we're reviewing a prospectus, but also when we're considering enforcement action. If we intend to bring an action against someone for violating good accounting principles and they're able to present a defense that says, well, our primary regulator reviewed these financials and said they're fine, it obviously makes it a somewhat more difficult case. Now, I'm not saying that is often the case, but on some of these things where the agency as a policy matter adopted a specific accounting principle that was designed, that was calculated to overstate, if you will, true economic net worth, it becomes increasingly difficult for others to attack that once that position is taken.
Why shouldn't the SEC set the accounting rules? What's the rationale for allowing the Financial Accounting Standards Board to do that in effect for you?
Well, we have ultimate authority over the accounting principles that are promulgated. The Commission historically has chosen to defer the establishment of standards to the professional accounting bodies rather than trying to do it within the agency, and I think that was a sound decision. I think we also have to realize, though, that we have a responsibility that we cannot necessarily just stand back and say that we will wait until principles are presented to us, and there are areas such as the issue of whether we should be moving toward market value accounting at a more brisk pace than has occurred in recent years, where I think the Commission needs to consider appropriate policies and at least make sure that those issues are being fully considered by the professional accounting bodies. I think it's a great strength of the accounting rules that we do have not just the decisions of an agency, as occurred in the setting of the thrift accounting principles, but where those principles are defined through a very careful and extensive process of consideration within the accounting profession and all the affected private concerns, as well as overseen by the SEC. And I think that's generally a good process and perhaps has more resilience and strength than if any single agency, ours or some other one, were simply declaring accounting rules by fiat. I think that would probably be a weaker system. Well, to return, and I won't belabor the remainder of some of these differences, but just to touch briefly on some of the other items. I had mentioned, Mr. Chairman, that some of the policies, the RAP policies that were completely at variance with GAAP, there were other areas in which the interpretation of GAAP varied from the interpretation that was utilized in other industries. For example, that was the case that we just spoke of in the question of what period could be utilized for booking goodwill, questions of the matching of the discount of goodwill in the income statement and the amortization on the expense side of the ledger. Some timing differences that were allowed through, again, interpretations of GAAP rather than a specific standard itself. Techniques of purchase accounting that were utilized in the thrift industry were in fact extremely significant. In 1982 alone, there was $15 billion in goodwill booked as an asset by thrifts as a result of mergers, in many cases involving what were called Phoenix transactions, where you'd have 3 or 4 institutions merging, and they were all insolvent. And the accounting was utilized then to write up the difference between their book value and their real value and create that as an asset on the books as goodwill. And so we had, in effect, the creation out of thin air of $15 billion in that year of value called goodwill. Now, that grew ultimately by the time FIRREA was enacted to more than $20 billion in goodwill that was being carried as part of the net worth and in the capital computations of the thrifts. That level of goodwill is enough at the then current level of capital requirements to support over $600 billion of loans for as long as 30, 40 years. And
some estimates of the total losses are in that range, so I mean, not that one directly connects to the other, but one might argue that item alone was sufficient to lever up something close to the total amount of losses that we're going to see in the system.
Well, it was enormously significant. In fact, in 1982, one of the charts we have demonstrates in 1982 the goodwill as a percentage of GAAP capital went from 6.48% in 1981 to 81.8% of aggregate industry net worth was purely goodwill. Got as high as 88% at one time, so that an industry that was growing at an enormously rapid rate, based purely on, backed up by...
Well, it was growing out of its problems. Wasn't that the theory?
That was the theory. What I have sometimes referred to as the Dare to be Great school of banking, that if you have a small insolvent institution, why not double or triple its size and hope that when you're through it'll be in better shape than it was when it started. And I think the results are clear, and they proved disastrous. And frankly, I think if an institution's creditors, private creditors, wanted to forbear, wanted to enter into, as happens as part of the Chapter 11 process,
Sure.
or even before a bankruptcy filing, happens every day.
Right.
Creditors may make a decision to, under certain conditions,
They're doing it with
reviewing-
Donald Trump. The banks are doing it with Donald Trump right now.
Happens every day. And if you're forbearing with your own money, that's one thing. But to say that we're going to ask the American public to be on the hook for a game of double or nothing is, I think, a very different matter. And these accounting rules were at the heart of how this was able to occur, and within the nominal appearance of solvency of the system, and that the ultimate resolution of the problem was able to be postponed so long. I do think, and I hope this doesn't sound unduly self-serving, but I think it's to the great credit of the President of the United States, President Bush, who within 17 days of taking office had the courage to finally stand up and say that this is a cancer that has been growing in the financial system for decades, and we're going to put an end to it. And came to the Congress with a plan to do that, and I think it's to the very great credit of this committee and to your chairmanship that the committee responded to that we didn't have a situation as occurred in earlier periods where some of the fixes took years to work through the legislative process, where we did develop tangible capital requirements and tough accounting rules. And the very item you were discussing this morning with the bank regulators, a requirement that the thrift capital rules in perpetuity be raised to the level of bank rules, that they could never be reduced to that, and a requirement that the accounting principles used in the thrift industries match those used in the banking industry. All those things that were accomplished as part of FERIA were the right thing to do, and they have been very important in reducing the chances of a further repetition of this. Sadly, they happened in some cases many years too late, but I think represented very important steps given what I think the origins of this problem were.
Well, you know, you've said something. I appreciate your kind personal reference there a moment ago, but you've said something that I think is very important today in the midst of all of this that helps make this something that can be understood, and that is that with this long history of this build-up and overlaying of problems, without going back and enumerating all the different items, but coming off this big interest rate jump and deregulation and interest rates and so forth, your phrase a moment ago that it was sort of a double or nothing strategy. And as we were, as a nation, coming down through the 1980s, and as this problem was more and more apparent, it seems to me that all of these different techniques that were added on the margin, the accounting techniques and net worth certificates and allowing goodwill to count as capital, and all of these different stretches and techniques were designed to, in effect, work the problem out. I mean, the theory was, here are these big losses that are embedded in there, and maybe there's a way, in effect, to have the future success cover the past losses. And it was in effect a double or nothing bet, or a triple or nothing bet, whatever. And but it didn't work. And you know, I don't know that anybody even wants to spend the time right now to think about that fact. But I think, in a sense, in terms of the anatomy of this almost a 20-year odyssey, or at least a 15-year odyssey, that's what happened. And we may be in the process of doing something like that right now in the banking system. I don't say on any one-for-one comparison basis, but because the situations are quite different. But let's hope we're not. But we certainly have an example of where I think there was a consensus to go the double or nothing route, and unfortunately, instead of getting nothing, we got double.
Well, Mr. Chairman, I think as you point out, the situation in the banking industry is very different. The banking regulators have always required positive levels of capital. The divergences between RAP and GAP in the banking industry have generally been to tighten GAP rather than to weaken it. And so I think there are some very important differences that I think should not be overlooked.
Absolutely. That's exactly right.
And I think, to the great credit of the banking agencies, that they have been willing to force very substantial increases in capital where that was required by the operating circumstances of the banks, and are continuing to keep on that pressure. So the history there is very, very different. I would say that I think one has to be I mean, it is a legitimate question of not only economic policy but political philosophy of who should be the party to make a decision to forbear, to enter into a workout rather than cutting your losses and putting an end to further operation of an insured institution. And there is a temptation sometimes on the part of those who are closest to a situation to seek to continue to work on that situation, or perhaps to engage in a rescue that is broader than needs to occur. And I know this committee has spent a great deal of time looking at the way in which some of the failures of very large institutions have been handled in the banking industry, and there's a great deal of debate within the industry over the so-called too big to fail doctrine. Recently we've seen some cases that are inexplicable under that doctrine, given the size of the institution, where creditors who were not within the scope of deposit insurance were in fact nonetheless made whole. And I think it is a fair question to say, well, what should the standards be for those types of forbearance decisions where the credit of the public ultimately is at stake? And I think the agencies need guidance in that area so that we have an understanding of the degree to which chances of further losses should be run versus recognizing that a given problem is insoluble. I know the agencies do the very best job that they can in making those judgments. They do need to have case-by-case flexibility because the judgments that they have to face are not cut and dried. But it's a difficult issue to define what the parameters ought to be of how long ultimately a given situation will be allowed to occur, and if it is going to be brought to an end, then what creditors are going to be paid. We have nominal decision in the insurance program of who's entitled to be paid, but sometimes people who are not legally entitled to be paid also, because of the way the transaction is covered, are made whole. And I think there again, that's something that the insurance study being done now will undoubtedly look at as the scope of that protection.
Let me ask you now, we've engaged in a sort of a running colloquy here, and that's a privilege that we seldom have, but because the fact that we don't have other members here presently, we've been able to conduct something of a dialogue. I want to make a point related to this, but I'm very mindful of how much longer you will need with respect to the statement, the summary statement that you're delivering, and I want to hear it all. So can you give me a sense as to how long that takes?
Oh, I could blaze through it here in about 3 or 4 more minutes.
All right.
We've covered, our colloquy has covered.
Well, we've covered a lot of these.
We've
covered a lot of these things, but I want to put one other thing in here, both for your mind and also for the record, because as we've gone back to do all the detective work to reconstruct this history, and you've added very importantly to it today. I think you've been able to shine some light on aspects of this problem more clearly and meaningfully than we have had before, and I thank you very much for that. One of the things that has been very striking to me that relates to this is we have looked at this pattern of sort of trying to leverage our way out of the problem over a long stretch of years and sort of doubling the bets and hoping that it would work, and then finding sadly at the end that it didn't. As we now are looking at the sort of harvest of RTC assets coming into repossession and failures and losses across the country, we've found that there was one more stretch that was sort of put on the end, along with the various accounting treatments and other things that you've mentioned. And that was this use of state powers under this dual banking system that we have, where states were allowed to take and very broadly expand the operating charters to find ways to use that money off this high leverage system that you described earlier. And we have found that in the last now 3 years, roughly 3.5 years, that 67% of the losses in the entire savings and loan system have occurred in state-chartered institutions in just 2 states, Texas and California. And that about, doing this from memory, about 10 65 or so % of the total assets in possession of the RTC now, and they're in every manner and shape in terms of the type of asset, but about 65% of the total assets are found just within the boundary lines of the state of Texas. Now, some are other places, but you see this remarkable concentration of loss at the end, and as you start going back through, you can start from today and work back through the problem over 10, 15, 20 years, or you can start in the early 1970s and work up, and you get the same story either way. But in terms of the thing that finally blew the gaping hole in the side of the ship, on top of the phony accounting and a lot of other things, I think was this extension of federal deposit insurance to state powers, which went way out of bounds, and we've stopped that as well in the FIREA bill. But I don't think, again, in that area there was ever a recognition of the scale of the multiplication of risk that was being set in motion, partly because we've got this dual system in our society. And it's just interesting to see how powerful the summary data looks when you look at it, because it's so atypical that it tells a story of its own.
I think it is. There is. That's a very important question, Mr. Chairman. Of course, in those states, the percentage of aggregate assets was also very, very high. I think I'm just recalling from memory that 31% of all the assets in the United States of America held by the thrift industry were in state-chartered California thrifts. So it stands to reason that they had an awful lot of the losses because they had an awful lot of the assets.
Yeah, but they did because they had a particular kind of charter. If they'd had a charter like existed in most of the other states in the country, that money wouldn't have been there.
Well, there was unquestionably, I think, an area in which there was competition among the chartering entities to offer a less restrictive environment in some areas. And up to a point, that's very healthy. When the New England states developed the NOW account.
Would you say that this aggregate data suggests that maybe we went past that point?
Well, I think one.
I mean, when you get
that's a fair inference from that data.
When you get 2/3 of the losses in 2 states and just state-chartered institutions in those states, and you get, my number was low, it's 69% of the total value of the assets in the RTC as of June 12th of this year, 69% were in the state of Texas. Within one state. Forget the other 49 states.
I am not going to sit here and justify in any way, shape, or form, because I think you and I share a revulsion to some of the practices that occurred in this industry. And I am not going to say that the absolute unlimited pouring of funds that some states permitted into wind farms and every esoteric investment that people could think up, including investments that were utilized by the thrift officers personally, that should have been allowed. And the freedom under state chartering statutes that Texas and California, Florida, and a few other states gave was an element of this picture. But I cannot excuse the Federal Savings and Loan Insurance Corporation and the Federal Home Loan Bank Board, who shouldn't have given those thrifts the money in the first place. Yeah, because you can't do any damage with asset powers if there's no cash in the till.
Right.
And it was the Bank Board and the FSLIC that had the power, like the FDIC had. I mean, we have state chartering statutes in banking, and states can authorize broader authorities, but the FDIC doesn't feel that it is required to bankroll all of those activities by the institutions that don't have capital. And so my personal view is that those authorities in some cases led to certain abuses, but those abuses wouldn't have happened had we not had this saga of ignoring capital requirements and allowing unbridled growth and giving them the money. And the federal government, the federal insurance regulator, could have prevented that, and I think was found wanting in doing that. Didn't do the job. So it is kind of a chicken or the egg problem as to which came first here, but I have to I focus on the fact that we allowed institutions that were already insolvent to essentially go out and borrow $650 billion from the public and play double or nothing. And that was a decision that could not have happened. I mean, the American public would not have given $600 billion to the savings and loans of America except for one thing, federal deposit insurance.
Yes.
And so I believe that the root of this problem was a combination of these accounting principles and the insurance device which produced the cash. And without the cash, the losses couldn't have occurred. If it's all right with you, I'll just finish off this statement here, and I'd like to particularly, we've touched on it already, I'd like to particularly address the question of market-based accounting and mark-to-market
key.
accounting.
I mean, this is, I think, some of the most important testimony you've given us in your prepared statement, and I really want to hear that.
Under current practice, GAAP for banks and thrifts, generally accepted accounting principles for banks and thrifts are based principally on the historic cost framework. These institutions are permitted to carry assets on their books at their amortized cost, even in those instances where the current value of the assets has eroded substantially and where a market-based standard would provide a far more accurate measure of the institution's financial health. As we enter the decade of the 1990s, we should consider a fundamental shift in the goal we set for accounting standards for financial institutions. Financial institutions are in the business of buying and selling financial instruments, all of which have a specific value measured in terms of current market conditions. Determining the value of an institution's assets, not recording their original cost, should increasingly be the goal toward which we should work. The nation's experience with the crisis in the savings and loan industry, as well as with many of the largest bank failures, demonstrates the inherent and very substantial dangers of a reporting system for financial institutions that is premised on historical cost accounting principles. Market-based information can permit regulators and investors alike to make a much more meaningful assessment of the real economic value and risk exposures of a financial institution. Knowing current market value also allows regulators to take appropriate actions before a situation deteriorates irretrievably. When a financial institution becomes insolvent, the loss to the insurance fund and ultimately to the taxpayers is measured based solely on the market values of its assets and liabilities. Historical costs are irrelevant in that process. Therefore, the risk exposure to the insurance system should be calculated on the same basis that its ultimate obligation will be calculated. Although in some cases market values cannot be precisely measured, where you have some illiquid instruments such as longer-term commercial notes, for example, it may be difficult to precisely value those instruments. On the other hand, it has been appropriately noted that the best possible estimate of a relevant concept is better than a precise measure of an irrelevant one. And there's certainly, if we put our minds to it, ways in which we could develop techniques for valuing even illiquid assets for which there's no readily quoted market value available. One possibility would be perhaps to develop haircuts on the value of such assets based on their age. That would in turn create a pressure, a slight incentive for the creation of secondary trading markets for some of these instruments that would liquefy institutions' portfolios. While some have argued that mark-to-market accounting would produce unacceptable volatility in operating results, market-based accounting has long been required of broker-dealers and investment companies. Thus, firms such as Salomon Brothers, Merrill Lynch, and others with tens of billions of dollars in securities positions routinely and daily use mark-to-market accounting without such problems. So, too, mutual funds with hundreds of billions of dollars in securities positions utilize daily mark-to-market accounting. It's therefore questionable whether this method of reporting by banks and thrifts would produce significant problems, especially as to their holdings of marketable securities, irrespective of whether they have a trading or investment intent. And that, of course, as you know, is the standard that's utilized under current practice. If the securities are held with an investment intent, then GAAP currently permits them to be recorded at cost, even if their current value has shrunk dramatically. If they are held with an intent for trading purposes, then they must be valued at market. My own personal belief is that our accounting system should seek to reflect economic value, not psychology. And I think the time and effort that is spent on determining whether an institution had the intent of trading instruments or of holding them to maturity is a very slippery standard to try and apply. It's very costly and is susceptible to a considerable amount of manipulation by institutions in various forms, and I think is something that we have to give very careful attention to, whether that distinction has any remaining validity. We recognize that the transition to full market value accounting is a complex undertaking. Studies are currently underway concerning these issues at the Treasury Department and in the accounting profession. However, the Commission believes that the objective of these efforts should be to achieve financial reporting that uses appropriate market-based measures of valuation at the earliest possible date. The Commission also recognizes that the move to a full-scale application of market-based accounting requires careful and deliberate planning, and in particular, we do not underestimate the significance or importance of problems of cost, problems of subjectivity of estimates, other specific issues that have been raised with respect to market-based accounting. But we do believe that resolution of these problems should be aggressively pursued. The thrift crisis confirms that effective regulation of financial institutions requires adherence to sound accounting principles, and it is essential for the purposes of both financial reporting and regulatory reporting that financial institutions adhere to accounting standards that result in an accurate portrayal of an institution's financial position and results of operation. I would hope we would learn from the disastrous experience of the thrift crisis as we move forward in developing both accounting and disclosure standards. Although accounting techniques were used to enhance the perception that thrifts were operating on a safe and sound basis, we know sadly from experience in many cases they were not. In the future, I believe that we must seek to become aware of insolvency or financial crisis at the earliest possible time, not when it's already too late.
Thank you very much for your views today and for your patience in allowing me to engage you at different points in what was a structured presentation that you spent some time preparing for the committee. Let me just take you through briefly 2 or 3 items here. In the crime bill that passed the Senate, as you know, there's a provision that called for open enforcement hearings and publication of all types of enforcement orders for banks and for thrifts. Now, the bank regulators generally respond that they have to do their enforcement work in secret or else the public will panic and there will be runs on those financial institutions. And I'm just wondering what you think of that argument.
I think public disclosure is the greatest disinfectant, one of the greatest disinfectants ever invented. We disclose every enforcement action against a broker-dealer, a firm, or against an individual if it amounts to over $100 in value, and I think that's an excellent policy. That I generally think, historically, it's true. The bank regulators have had there has been an attitude and approach to problems that they should, that we shouldn't worry the public, and we should try and resolve these matters confidentially. But I think we have probably erred too much on the side of keeping matters that investors and the public should be entitled to know about, and that have a great deterrent effect when they are disclosed, that we should make more use of the disclosure of these matters.
I agree with you, and my inclination runs along those same lines. I think there's a real disinfectant power to that, and I also think there is it creates an incentive for people, I think, to be quite careful. I think it's one thing if you know that you not only face an enforcement action, but you're going to face it in the full light of day. I think would have a beneficial effect on conduct before the fact. And but I appreciate your view on that. Let me ask you this. In 1987, here in this committee, I was serving as chairman of the Securities Subcommittee, and we issued a report at that time that accompanied the authorization for the SEC bill, and this would have been January of 1987. And in the report, we said this, quote, "The surge in well-publicized instances of fraudulent activities by persons associated with savings and loan and other financial institutions raise serious questions. An enhanced governmental enforcement presence is clearly warranted. The subcommittee requests that the SEC, in coordination with the various interested bank regulatory agencies, promptly address this serious issue. Can you tell us, you were not there at that time, but you're there now, and can you tell us what, can you tell the committee what the SEC has been doing in that respect under your stewardship since you've taken over?
And this is to coordinate with the bank regulators, or
to coordinate with the bank regulators and to crack down on clearly the pattern that was emerging at that time and was I think there to be seen.
Well, shortly after I became chairman, I did create within our enforcement division a special task force to review matters relating to filings by depository institutions, banks and thrifts. We created a similar unit within our corporation finance division that reviews the securities filings we were talking about earlier. Both of these efforts were taken to try and improve the speed and effectiveness of our own oversight as to bank and thrift holding companies and the financial reporting and securities disclosure practices that they may have followed. In part, and I wouldn't want to create a suggestion that these institutions have not been complying with the law, but as we were discussing in our colloquy earlier, there are a number of unique accounting principles, for example, that are followed in these institutions, and we thought having a dedicated group of people who are familiar with that, rather than having these filings occur randomly throughout the staff, that we would, as a management technique, try and have a group of people who were fully literate in those practices and could be as critical as possible in their ability to review. Critical not in always objecting, but would be as capable as possible in reviewing those specific filings on the corporation finance side. In the enforcement side, we have dedicated what for us, and we're a small agency, is a very large number of a very large amount of enforcement resources looking at cases in the bank and thrift industries, and we have, I regret to say that we have a fair number of referrals that have been made to that unit, and that we have a fairly healthy number of cases that it is working on quite actively at the moment, and I think in the next few months there will be a number of cases that will be brought publicly. I'm not at liberty to discuss them now, but where I think we have found certain practices that did not comply with the law, and where we will be forced to take action to deal with that.
Good. I'm glad you're acting on it. Do you need more people?
Well, I have been. I've watched in the budget deliberations at the hiring of hundreds, literally, of lawyers, and I think and other professionals, and very usefully in the Department of Justice and in the FDIC and RTC and OTS to look at thrift fraud. We have not been part of those special S&L appropriations and special enforcement authorities personnel-wise, and we've been trying to do this all out of our existing resources. So I'm trying to do absolutely the most I can out of our current budget.
Well, if you don't have enough, though, and let's be very blunt about it, I want to see that you have enough. And so, you know, I don't know what the problems are of navigating the bureaucracy of OMB and what have you, but if you need more people, you must tell us, and I'll do everything I can to get the additional people for you.
Well, I appreciate that, Senator. In fact, the Mr. Chairman, both OMB and the Congress have been generally very good to us. In the last year, we had a substantial increase in personnel, and OMB has requested a similar an increase again this year. We have not had a personnel constraint so far, in the sense that because, unlike our colleagues, unfortunately, our greatest problem is not the personnel ceilings per se, but it's the pay cap limitations we operate in. We'd love to be able to hire a few senior examiners and
You know, we
senior
agree with you on that
supervisory
issue.
authorities
We've been pushing hard on
from the
that.
bank regulatory agencies to use in our own proceedings, except we can't afford to hire any of them because they're already making twice what they would make at the SEC. So that's more of a problem than the absolute numbers is. But we're making, I think, good progress. I certainly will not hesitate to tell you if we think we could use more personnel. At the outset, it's been important to get that effort up and running. As we get it moving forward, I think we may find that we can usefully employ additional personnel.
Well, let us know if that's the case, and I'll do what I can to get it for you. And I share your view on the salary caps. As you know, we've been working on that issue. Finally, earlier this morning, as I know you are aware, the bank regulators gave their view on forbearance or delayed closure, and we've talked some about that for banks or thrifts that are undercapitalized but still solvent. And I'm just wondering what your views are on delayed closure.
Let me first indicate that the Commission, as you know, comes out of a somewhat different structure and background. We do not have a deposit insurance program. The obligations, in many cases enormous obligations, of broker-dealer firms and their parent organizations are not guaranteed by the public. We do not believe they should be guaranteed by the public. I would be very concerned if any structural change to allow banks broader participation in the securities industry extended the public safety net into the securities industry. I don't think the public ought to be asked to back up the activities of individuals or firms in the securities world. When we confronted a very large failure, certainly as large as many of the bank failures, in the case of Drexel earlier this year, a $28 billion firm, we were not willing to see the creation for the first time of a safety net through public extension of public funds to such a firm. Drexel was forced to use the bankruptcy courts. The ultimate closure of that firm has to date not cost the American public a dollar, other than the normal salary of the SEC personnel who might be following it. But a very, very large institution, one of the 10 largest securities firms in the world, was closed at zero cost to the public. And that is, in my judgment, the way it ought to be. And so we come at these questions from a slightly different perspective. We think people who are uninsured creditors ought to make their own credit decisions, and if they make a mistake on that, then that's their problem, and the public shouldn't be asked to pay for it. So I am not a fan of forbearance. I'm not a fan of using public credit to extend the time of institutions that can't raise anywhere in the world capital. If no investor anywhere in the world has confidence that a given set of management knows how to handle its problems, then I don't know why the American public ought to be asked to put their credit at risk to support that institution. So I have a hard time understanding some of the individual decisions that were made that are made on particularly smaller firms, and as a general philosophy, I think forbearance can be a very slippery slope down which we can go, and we have a process that operates for the rest of the economy for handling insolvent firms. It's a good one, and we ought to use it more often.
How closely does the SEC monitor the sufficiency of the SIPC fund, or the SIPC insurance system, if you will?
Well, we have a relationship with SIPC. We work with SIPC. It is not, as you know, it is not, does not include public funding in the same nature as the depository institutions. We are not even by statute on the board of SIPC. There are a number of...
If we wanted to take a look at that, would we ask you to help us, or who should we ask to help us?
Well, initially I would suspect that the SIPC personnel themselves would be the logical place. We do have work with SIPC, and I'd be happy to respond in any way that the committee found desirable to questions relating to SIPC.
Are you convinced, as you sit here now, that there's plenty of cushion there to protect shareholders out across the country?
Well, I would first not to
customers,
not to quibble, but I think it's very important that people understand that what SIPC is and what it isn't. SIPC does not insure the value of people's investments. It secures individuals against defalcation, against
Yes,
theft
exactly.
of securities that they may have.
Well, or
And-
does it not also attempt to ensure in a situation where if you had a sort of catastrophic event strike and securities firm, found itself turned upside down very quickly and couldn't pay off its accounts, that wouldn't be fraud. That would simply be an inability to return someone's money. Wouldn't the protection be thought to apply in that case or not?
Well, the protection isn't needed in that case because, first of all, a customer's securities are required to be segregated. The firm can't be
No, but I'm
dealing
saying,
with
well, I know,
customer
but they've got to
securities.
be
They're
able to have enough
required to
money
be
in a-
protected.
Yeah, but they've got to have enough money in a bank account at the end of the day to be able to pay those off.
No, but those securities must be segregated and held apart from the firm's, whatever the firm is doing for its own account and the business it's doing. It can't simply use the customer's funds and then at the end of the day put them back again. There are requirements that customer positions be segregated and held aside so that
And so
this
the
problem doesn't
firewalls that are
arise.
there in that instance, in your
There-
view, are sufficient, and we don't really need to worry about that.
Well, it is very important, the firewalls that exist within a firm to prevent the firm essentially embezzling a customer's securities and using it for its own account. That's terribly important in cases such as a number of cases, including, I believe, the recent Stotler case in the futures side, where you have firms that are pressured to begin to invade those segregation requirements. It's very important to stay on top of that and to strike instantly if you find that kind of behavior going on. So that's one important line of defense that makes it very different than the banking world, where your deposit is designed to be lent out by the
Right.
firm and is not in a segregated account. I do think one of the things that ought to be looked at in the course of banking reforms and deposit insurance reform would be greater utilization of something like not necessarily a narrow bank, but maybe a narrow account where customer funds, like a money market fund, are in specific marketable instruments and are held in a trust and protected the same way we hold customer securities in a securities fund. So that's one very important defense. The other that is absolutely critical, and I know we touched on it earlier, but is the fact that every day we mark the securities firms to market, so that we don't wake up one morning and find that a firm that was reporting on a cost basis that it had a positive net worth of billions of dollars, in fact is insolvent on a true market basis. When a firm starts a slide in the securities world because of that daily discipline, we like to think that we find out about it in time to take the necessary action. And so the size of SIPC has to be evaluated, not comparing it to the size necessarily of the banking fund, but in comparison with these other very, very important lines of defense.
Now, with respect to an individual's money held by a securities firm that is for the purpose of investing in securities, and securities are held by the firm in the name of the person and so forth, setting that to the side, if you take just a money market account, for example, the degree to which there is the safeguard there that will ensure the repayment of money that someone might have in a money market account.
Well, there, 100% of the assets of the entire fund go into liquid instruments, whether they're Treasury securities or other money market instruments. Those instruments are held in a trust. There's no permitted self-dealing. They can't invest, the fund can't invest in the commercial paper of the sponsoring organization. It can't even make deposits with the sponsoring organization. So the customer money is pooled together, put in liquid instruments that have that can be sold every day, have a fully quoted market value, and they're protected in that trust environment. And of course, you do not have, as you have in the banking system, a guarantee that $100 in will come back as $100. You have a share, a fraction of a fund, and that your value of your share can go up and down.
But do you think a person that has a money market account at a securities firm thinks that if they put in $1,000 in a money market account and paying an interest rate, that they might they put in $1,000, they might only get $500 back?
I don't think they think that, nor would I want them to think that. In fact, the dollar per share net asset value pricing has never been broken. While a few...
No, I don't want it to be broken either, and I'm not suggesting it's going to be broken. I just want you to explain for the record, because I think it's important to have it there,